Well, there he is, Mr. Durrett himself, a punctual man. I like it. Mr. Durrett, we'll get you up here to speak. If this is your first time on Spaces, um, you'll be invited up to speak, and then in the bottom left corner, you'll have an option to unmute your microphone. But as we get that going, I'll introduce you. Mr. Durrett is a popular author of many books, including How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. It's the first and only book of its kind. It's available on Amazon in paperback, and you can even download it onto your Kindle if you so desire. Mr. Durrett is also the founder and publisher of the Gold Stock Data newsletter, where he's very well known for his pursuit of 10 baggers and due diligence in the mining space, and he's even a contributor to Seeking Alpha. So if you're looking to be an investor in the gold and silver space, Mr. Durrett is exactly the man to help get you started. But look no further because he's right here with us. How you doing today, sir? Thanks for coming in. It's a pleasure to have you.
So yeah, first time on Spaces as a speaker. Thanks for having me on.
Well, like I said, it's a real pleasure to have you. These spaces are really unique. They're really taking over, and they are brand new, so it's kind of new for all of us. But I'd like to get started here by setting up the macro situation, especially for those who may be new to the space or trying to figure out what's going on, what this all means and why this is all important and how we can use this information to anticipate what comes next from a macro perspective. So I'd really like to set the stage and build the foundation to stand on for kind of more drilled in specifics for gold and silver and here in a little bit after we kind of lay it out first. So with that being said, I'd like to start here a little bit more localized in the U.S. bond market. As you know, the bond market's been inverted for several weeks. It's inverted for the third time so far this cycle. When you look at the bond market right now, especially price action lately and coming into this week, what kind of signals are you seeing the bond market telling us right now? How should we interpret that? And for the markets broadly, but also what they think about the Fed?
Well, I didn't think the bond market would go over 3.5, just because once you get above 3.5, it gets really difficult for the U.S. government to be able to have a budget of any kind, because once you get over 3.5, you start looking at $800 billion to $1 trillion in annual interest payments. So I didn't expect it to go over 3.5. So I looked at a range somewhere 2.5 to 3.5 as the Fed increases rates. So they're still increasing. So we're kind of in that, in that range. So the question is, after they finish raising rates, and I think it's going to happen in September, I think they'll raise one more time. Then we'll see what the 10-year wants to do. I don't think it's going to go higher. So does it get stuck until they actually pivot? Does it kind of get stuck here? So I don't know. I think it's probably wants to go lower once they pivot. And then some people think it's going to go all the way back to zero. I'm not really, it's hard to imagine it going all the way to zero. It's hard to predict exactly what's going to happen after they pivot. But the bond market to me isn't really that significant here. As far as the macro, as far as what's going to drive gold, I think that's more of a driving kind of the economy per se. And it's going to be more of a lot of other factors, I think, that are going to drive gold other than the bond market.
Okay. Could fear be one of those drivers? I mean, I feel like the fear trade gets a little underappreciated, especially for these times. I mean, you hear a lot of pitches to invest in gold for the fundamental reasons, for the, the fiat currency reasons, for inflation, and we all have the bullet points, but nobody really talks about fear anymore. Do you consider fear a big driver?
I've actually, that's for me the number one driver by far. As a matter of fact, I get into a lot of the people that do, I'm on Twitter a lot, and the people that do that I argue with, I probably argue, that's one of the topics that I do argue about with people, because I'm adamant that the number one driver of gold to an all-time high is fear. I call it systemic fear, systemic risk. And for me, the dollar, the dollar is really high right now, and it's definitely keeping gold down. At 106, 107, it's definitely been a big indicator. And we talk about real rates being negative right now. That's supposed to help gold, but it's not, is it? So for me, it's like, I'm a long-term investor. The only reason I'm in this is to have outside gains. I don't care about 100% return. I don't care about annual returns of 20 to 50%. I'm after outside gains. So I'm looking at this as a once in a lifetime situation here, where gold goes to 2,500 plus. And even 2,500 to me is really, it's a target. It's a starting target for me. I want to make it to at least 3,000. For me, it's the run from 2,000 to 3,000, 2,000 to 3,500 gold. The only thing that's going to make that happen, in my opinion, is the fear, the uncertainty of systemic risk. We talk about the macro factors. For me, I've been doing this for a long time. I mean, I actually started analyzing the economy in 1980. So I'm 62 years old. I've been doing this for a long time. I remember living through the 80s, what Ronald Reagan started to do. He started to change the whole, and what Reagan put in motion is still with us today, the whole Keynesian thing, where Reagan, we had a recession in the early 80s. It started going away around 82, 83, and Reagan all the way through 88, he did basically, these large deficits, and he basically pumped the economy. He lowered taxes significantly, but he also used deficits. So it was like a double pump, and he pumped the economy and it worked and everything got on its feet. And then we had technology kicked into gear, but we never stopped that Keynesian. As a matter of fact, we did away with Keynesian, and now we're using MMT, where when we had the Keynesian economics back in the 80s, we were still afraid of debt. So as a matter of fact, Newt Gingrich came into power in the early 90s, and he started balancing the budget. And he actually did balance the budget by the end of the 90s with his contract with America. And then once 2001 hit, 2000 was when the dot-com busted, and then 2001 is when we had the 9/11 attacks. And that was when MMT began in the United States. Hank Paulson really instigated it, which he was under Bush, which was the Republican administration in 2007-8. Hank Paulson basically is the father of MMT, and I don't think he really wanted to be one. But after that, it was kind of, nobody's talked about deficits since then. So the macro environment since 2008 has been very nasty. The U.S. economy, I call it a Potemkin economy because it's not real. It's based on stimulus. It's not based on real growth. It's based on fake growth. So that's where we're at today. So I think the fear factor is getting ready to be exposed because the U.S. economy can no longer basically grow at a rate that is sustainable without debt.
Right. And that's a good train of thought. Let's stay on that macro. So if you consider fear being a large catalyst in this trade, it obviously implies that you're looking for something to break. And I'm curious, we have a lot of macro situations playing out right now with the bifurcation of the world. There's Russia, there's China, there are our own domestic issues with inflation, the economy, the stock market, there's leverage. What do you see as the most risky spot right now? What do you see as the greatest danger that's going to bring on this fear?
So what's happening now? Again, I've been doing this since 1980. I've been analyzing it for a long time. So this is a culmination event that's happening right now, in my opinion. So the culmination event is kind of the end, what I call the end of the U.S. era, which I do every Friday night. I do a GSD Friday night recap, and the last sentence in my recap was, we're approaching the end of an era. So this is all culminating. It's been building, going back to, I think, 2000. The dot-com bubble popped, and then the U.S. no longer. We started deindustrializing in the 1980s, and we got away with it through the 90s because of all the technology boom. But the debt, once we got into this century, the deindustrialization started having these negative feedback loops where you just you have to have stimulus in order to prevent a recession. So if you look at 2013, 2015, 16, 18, 19, the Fed has been stimulating every time the economy did any type of a slowdown. You look at the money supply. Anytime the S&P 500 started to weaken, roll over, they started injecting money. It's almost correlated. So can they get away with that? How much longer can they get away with that? I think that 2000, the COVID event, if you will, damaged the U.S. economy permanently. So I don't think the U.S. economy now is going to get back on its feet again. I think right now we're going into a transition period. In the transition period, this a recession. I don't believe it's going to be a soft landing. I don't think we're going to crash either. I think we're going to muddle. We're going to turn Japanese here. So we're going to turn Japanese with flat growth, and the flat growth is going to steadily expose all the leverage that's out there. And so we're going to have a few Lehman type events where you're going to need bailouts of kind of large corporations that have debt problems, pension problems that need bailouts. So the bailouts are going to start happening. All of these things are going to start to have an impact. But the one thing, the big key here for the risk trade, the fear trade, is going to be a lack of growth. So right now, Wall Street is expecting the Fed to pivot here this year. And I think the pivot this year could possibly happen in November, December, but the pivot will, I don't think with the lower rates. I think what they'll do is they're going to say they've changed, and they're now they're no longer raising rates. They're pausing. And then at that point in time, we're going to see Wall Street's going to be expecting everything to kind of blast off. But we're going to be heading into a slowdown. We're going to be heading into a recession, so the stock market won't be able to blast off. But it's not going to crash because MMT is going to be with us. We know that. We know the Fed's going to expand their balance sheet. We know the U.S. government's going to expand their debt. So it's right now $23 trillion is how much we have to basically pay interest on. So I think that's going to keep going higher, higher, higher. And so everything's going to start to slowly, I don't think it's going to happen quickly. I think it's going to slowly start to expose itself as being, this sluggishness where the U.S. is depending on debt. And this is where, it's hard to predict exactly how it's going to unfold, but I call it an end of an era. So you're going to start to see Asia basically flexing its muscle. And I think that the Ukraine was a black swan event where the U.S. dollar, where right now it's 87% of trade, I think you're going to start to see that start to shrink because I think something's going to happen with the BRIC Plus. They're going to start to move away from the dollar. I think Japan and China are both going to start to sell their treasuries. China's now under 1 trillion. I think they're going to steadily go down once they get under 800 and 700 billion, excuse me. I think Japan's going to join them and start to sell. And then this is going to be basically a scenario where New York City starts to lose its hegemony as the global dominant financial center of the world. And the U.S. economy starts to stagnate, not crash, just stagnate, muddle, and things start shifting, and we're going to go into it, basically start going into this new era, and the gold is going to benefit. When does gold break out? When does gold sniff out these changes that I'm saying are coming? I think next year, I think 2023, I think gold will sniff it out.
I love this train of thought that you're on, and I want to stay on it. You mentioned the end of an era, and so I'm going to lay out a situation for you. You talked about Lehman events. We talked about sovereign debt. This is a global problem, and so we understood that the Fed never really had any true power to stop inflation. They could never raise rates meaningfully because of our debt, like we talked about, but they're raising rates anyway. I have a question for you on the backdrop of everything you just said. So could it be that what the Fed is doing at the end of this era, okay, with all this sovereign debt crisis around the world, these problems for everybody, that what the Fed's doing, and people are beginning to rationalize that the Fed never really had intentions on stopping inflation, but really what they're doing is they're focused on the global sovereign debt crisis. And so, in order to prevent that Lehman moment from being born in America again, they're weaponizing dollar strength to break the back of a foreign sovereign first, so that wherever that first domino drops, it'll happen somewhere else instead of the heart of America. Do you think that has any legitimacy to it, or it's a little too deep in the conspiratorial water?
Yeah, I've heard that argument, and I'm not buying it. I think it is a conspiracy type an idea. I mean, it's possible, but I prefer to focus more on Occam's razor. You know, what kind of a pickle are they actually in? That type of an argument basically states that the Fed will be able to pivot around, basically maintain the U.S.'s economic position in the world. And I think the time, basically our time is up. And I don't think that they're going to be able to basically push all the problems onto Europe or push all the problems onto Asia. And the U.S. maintains its dominant position. I just don't think that's going to be the outcome here. I could be wrong, of course, but I just think that the U.S. made a big mistake when it deindustrialized under Reagan, when Reagan basically started focusing on globalization and free trade, and basically telling the U.S. corporations, look, you guys are the dominant players, go and take advantage of that. And that's what we did. You know, we started taking advantage of our position around the world, and then we used our military to kind of back it up. I mean, we have, I don't know the exact number of bases around the world, but it's over 300 or something. But we have 300 bases, but yet we don't really have any enemies. I mean, who's going to attack the United States? So what are those bases for? They're all for economics. They're all for maintaining our economic position in the world. You know, I had a friend, he was international relations major, and he used to always tell me just follow the money. It's not about economic security. I mean, it's not about military security. It's about economic security. It's always about following the money. All of our intelligence, they're all about making sure that the U.S. maintains its economic dominance. That's what it's all about. And so we're at a point now where the U.S. can no longer maintain its economic dominance, because if you look at the size of the economy globally, Europe's economy is actually bigger than ours. Asia's economy, if you add it all together, is bigger than ours. The BRICS now combined are bigger than the G8. So everything is slowly slipping through our fingers. So if we look at what's happening right now in the world economically, if we look at the Ukraine situation, Ukraine was the number one country ally for Russia, bar none, and the U.S. knew this. Brzezinski wrote a book. I forget the title. I can't think of the name of the title of his book. It'll come to me. But Brzezinski, he basically says in that book, he says it at least 10 times. He gets over and over and over again. He says that Russia has to be allied with Ukraine. It cannot allow Ukraine to be allied with the West, because that isolates the Russia. It isolates them. They basically don't have any other allies other than Belarus, which is a small country. They just don't have any. Russia is just, they're like Japan. Japan's kind of similar. They just don't have a lot of natural allies. And so since they don't have a lot of natural allies, they just were totally dependent on the Ukraine in order for them to feel somewhat defended against any aggression from the U.S. or any aggression from the West. And so the U.S., Brzezinski basically said that the U.S. would be isolated from the rest of the world if Russia allied with Eastern Europe and allied with China. If all of those countries kind of allied together, you would create a Eurasian economic bloc. So the Eurasian economic bloc would be India and China and Pakistan, and then all of Eastern Europe, and then all of Asia, Asian countries, including the Russian satellites. All of those would basically create this one massive economic bloc. And that was the threat to the United States, because if you created that massive bloc, the U.S. would be on the outside looking in. And the only ally that the U.S. would really have would be Japan. And that's not enough. So the U.S. couldn't allow that to happen. So you think, why did this war occur? It occurred because the U.S. wanted to make sure that it was the economic player in the world. And if it didn't have that strong NATO influence. The NATO influence was the US's, that was their in for maintaining its strength in Europe. Without that, and that's why the US has been basically isolating Russia ever since 1989, when the Berlin Wall fell down. We've never tried to be friends with them, and when Trump tried to be friends with them, he got attacked ruthlessly, right? And so now we're seeing exactly what this war was all about. It was basically all about making sure that the U.S. isolated Russia, and so now we're seeing that it's kind of backfiring on us. Russia, it's brutal what they're doing. Absolutely brutal. It's ugly. You can't defend it. All the, 1,000 people that are dying. You can't defend it, right? But then if you look at the U.S.'s aggression over the last 50 years, it's been pretty ruthless as well. Okay, that's not defendable either. But we're talking about gold. We're talking about the macro. We're talking about all these things and how they all fit together. And what's happening in Europe, what's happening in Asia is a big, big factor in where gold's going, why gold's going higher, why the U.S. economy is going lower, why the U.S. economy is going to be flat, why the U.S. economy is going to have a difficult growing. We've deindustrialized. It's going to be almost impossible for us to reindustrialize. We're not even trying to reindustrialize. And that, which is a huge, huge mistake. I thought that Trump was going to try to reindustrialize, but he didn't. That was his flaw, in my opinion. His number one flaw was not reindustrializing. And so now the U.S. is going to try to use the dollar to leverage its current economic strength. But I think that the dollar is going to slowly go down after. I don't know what's going to top here. I thought 115 is probably a good number. 110, 115. I don't think it's done going higher here. But once it peaks and then once they pivot, I think it's going to go lower, lower, lower. My target for the dollar is actually 70. And so if it goes to 70, that's going to take gold to 3,000. And so how does it go to 70? Everybody goes, that's impossible, because Japan and the euro is 70%, 67, I think, percent of the DXY. How does it go to 70? But I can make some arguments for why.
Right. So I really want to get into gold and silver specifically with you, but a couple of more questions and follow-ups on the macro here. So as you talked about Eurasia, can you help me understand? I'm having a trouble really pinpointing what's happening in China. It's hard to make sense of it, and it's hard to get good news, but they're closing their economy from what we can tell over the virus again. They're dumping their treasuries. Meanwhile, they're experiencing revolt and bank runs. People aren't paying their mortgages. They're bringing tanks in the street. What's your sense of what's going on out there? It really feels like we are already in a global world war that's based on economics and monetary systems.
So China is definitely our economic foe. They're not our military foe. And China has been positioning themselves since the 90s, and especially this decade, as taking over global dominance economically, being the number one player. They have been the outsider. They're not in the G8. The U.S. has basically isolated China. China does not want their currency to be the global reserve currency. but simultaneous to that, they don't want the U.S. dollar to be it either. So they've been positioning themselves to they know that the U.S. has basically been the bully on the block, keeping them isolated, not allowing them to, be kind of a global player per se. Just the fact that they're not part of the G8 shows you that. But China has advantages that we don't. For instance, they can change on a dime their economic policies. I think they are making a mistake by printing too much money. They're printing more money than we are. I think that is a mistake. So they're basically playing the MMT game as well, but they don't have as much debt as we have. And their debt is all internally funded like Japan's, which gives them advantages. Same with Europe. I talked about why I think the dollar's going to 70, because the reason why is because we have the euro dollar, and the euro dollar is actually, people might not know exactly what the euro dollar is. All the euro dollar is US dollars in foreign banks, not just European banks, but Asian banks as well, where they make loans in dollars in these foreign countries. Those are called basically euro dollar. So you have these euro dollar loans. They're basically loans made in foreign countries where they have to pay back in dollars. And so there's actually more U.S. dollars floating around internationally than in the United States because of the euro dollar. And China wants to kind of figure out a way to kind of break that system because it gives the U.S. a little bit too much of an advantage over them. So how do they do that? I'm not sure, but I know they want to. They're making more alignments with other countries where they actually make these international trade deals in other currencies, not dollars. But it doesn't necessarily have to be yuan as well. And that's going to be ongoing. But the one thing you mentioned is this trade war. This trade war is real. Trump was the first guy to basically bring it up. He recognized it. He recognized he always talked about how the Chinese were taking advantage of us, and definitely they were. And they're buying up our assets. Buying up our companies, trying to get an advantage over us. And he was one of the first guys to basically say, look, we are in a trade war with China. We need to make it more of a level playing field. So he put the tariffs up, and then Biden came in and he maintained them. Why did he maintain them? Because they did the analysis and said, wow, Trump was right. We need to maintain those tariffs too. And so the U.S. Under Trump was the first guy to acknowledge that we're in a trade war with China, and now I think Biden's acknowledged it. I don't think the U.S. now will kind of let that go. I think that trade war is real, but China has an advantage because China now is teaming up with these other Asian countries against the U.S. He's teamed up with Russia, which is a natural enemy of China because they're basically fighting over the same resources in the same area. They're not natural allies. As a matter of fact, Russia is a natural ally of the United States, but we were afraid of Eurasia, so we made them a natural enemy, which is kind of a mistake. That was two mistakes the U.S. made. We made the mistake to deindustrialize. We made the mistake to make Russia an enemy. So I think that China is going to use Russia to leverage this trade war against the United States. I think you're going to start to see China starts to leverage its power over these American corporations in China. I don't know when it'll happen, but this is a trade war that's going to expand. It's going to hurt the United States over time. It's going to hurt us this decade. We're in a real bad situation here, and it's not being basically acknowledged by the U.S. media. It's not being acknowledged by Wall Street. We're just in denial that this trade war is happening. We're in denial that we're basically vulnerable, very vulnerable here.
Well, I could ask you these questions forever, but we're trying to be mindful of your time. And you're on an absolute tear, by the way. It's great stuff. So one more before we move on to gold and silver itself. Could you
Mhm.
just touch on the central bank digital currencies? What's the reason for it in your mind? Is it more about control, or is it more about reinventing the dollar in anticipation of what's to come?
Yeah, it's all about control. It's all about power. We're seeing, we saw it with COVID. They're basically they want to. America was always built on freedom, right? And as the government becomes more powerful, more entrenched in our lives, they want to dictate how we live, and they want to basically change the whole not overview, but the whole kind of fundamental direction of America, the direction of the individual having the control over himself, self sovereignty, where an individual can create his own future, can go create a business, and then from there, who knows how big the business is going to get, and then that individual can run for president. I mean, that whole individualism, that whole meritocracy is right now under threat in America, and as that kind of goes south, the government wants more control over our lives. I think that America is kind of we're in a strange place right now. It's almost as if we're going towards the Chinese model, where the government kind of controls the economy. The economy maintains everything, manipulates the whole economy. The free market kind of goes away. We're seeing that before our eyes. We're seeing the free market die because the Fed is becoming too influential in the marketplace. And so, in tandem with the Fed becoming and the government becoming too entrenched in directing the economy, simultaneous to that, it wants to control individuals. If it's controlling businesses and economy, it's going to want to also control individuals. So the currency, if you can implement something like that, then the government literally if it can control your bank accounts, it can have leverage over how you live your lives, right? It can basically decide, if it can decide who is no longer a good citizen. We have these social scores, and everybody scored on how they're living their lives, and then we can basically take away your income, take away your money, take away the power is unbelievable. If the government creates digital wallets, and it's yes, it's about control. The potential's there. So America is kind of at a crossroads right now. Do we go in a new direction where freedom is no longer what it once was, and freedom is now a privilege? And I think that's a scary thing. Is that if they basically do away with cash, and they do away with the only way that you can spend money is through a digital wallet, at that point, money becomes privilege. Now, I always thought that everything is kind of a slippery slope. When they basically say that driving a car is a privilege. You have to have a license. You have to have insurance. You have to wear a seatbelt. All these things are a privilege. It's a slippery slope. Then the next thing is it's a privilege to be an American. It's a privilege to have a passport. It's a privilege to have a bank account. Everything becomes a privilege. It's a privilege to go to school. If you're not vaccinated, you can't go to school, et cetera, et cetera. Everything's a privilege. It's a very slippery slope. It's a very scary time. I grew up in the 60s when we had total freedom, basically. And so I've seen the slippery slope unfold. And so it's a very scary time. How far does that slippery slope unfold? So I just wrote a political book, it's just America's political Cold War. I want everybody to see exactly where we're going, and why both political parties are not the answer.
Right, right. And we had evidence, I think, recently with Russia how some of this could potentially play out. I mean, you saw people in Russia try to run to Bitcoin, and they cut off the on ramp and wouldn't let them on
Yes.
through Coinbase.
Yes.
And it's just a little taste of how easy it is and how much control they have. And they did it with the flick of
Yes.
a switch. It took
Yes.
no time, which is
Yes.
evident again how they've already thought about this.
Yes.
And this whole conversation just makes me want to load the physical stuff before, while I still have a
Yes.
boat to put it in.
Right.
uh, so, about the physical, about the good stuff, let's talk about gold. Big pivot, big rebound on the charts here at about 1680, 1678, I think it was on the tick. So, a pretty nice weekly candle. Not a lot of volume, but the candle's nice. So, seeing this bounce this week on the charts and the price action of gold, are you breathing a sigh of relief or are you sweating bullets here?
Yeah, no sigh of the reef. I mean, I've been talking about 1680 and 1850 on silver for months now, how important those levels are. But the problem is that we're bouncing on those levels. I mean, we got 1 week of a reprieve, but the problem is that the markets are going lower, and so if the markets are going lower, the odds are against us at this point in time. So the HUI is at 201, 203. I mean, it's really low, but I don't think we're going to have to get really lucky to for these levels to hold. So for me, it's about one of them holding. We need at least one to hold. If one of them holds, then the HUI could maybe hold at 190, 200 here, which wouldn't be basically would be really close to the bottom. But if they both break down, which I think is probably what's going to happen, because the markets aren't done selling off. We almost hit 4,000 on Friday on the S&P. It's another one of these. I think it's the fifth dead cat bounce. So we're going lower. The markets are going a lot lower actually. So we're at 30. We're at four. Let's say we're at 4,000 S&P. I think we're going down at least to 30, say 500. I think 3,300 to 3,400 is kind of my target, but at least 3,500. So that's, a 10% drop, and we're probably going to go down 20%. So we're looking at a 10 to 20% drop in the markets. How do you go down 10 to 20% in the markets and gold and silver hold? The odds are not good. So I think the HUI, let's look at gold first. I think gold is probably going to go down to 1575 to say 1625, somewhere in there. And 1575 might not hold. So we cross our fingers, but I think that's the target we have to look at. Silver could be even nastier because silver's a little bit more volatile. So we could definitely get a 16 handle here, and it wouldn't be crazy talk to you to say a 15 handle. So we're looking at some really ugly numbers here in gold and silver, just because we're going into more selling here. The market, I just don't see any way the S&P is going higher. I mean, right now, just, okay, 4,000 at the bottom, we're going up. I think we're going down 10 to 20% lower before we find a bottom. And so we're just going into recession. The recession is just starting. The mass layoffs haven't even started yet. So we got this nasty selling that's coming. So we got nasty selling coming. You have to expect these levels to basically not hold. The only way that they hold is we have, some type of black swan that makes gold all of a suddenly attractive, and gold goes up $50 in a day, and everybody wants to buy gold. I just don't see that right now. I don't see any event out there. There's one, and that's Russia. Russia could make basically say we're going to sell our oil and natural gas and gold. That would probably there's a second one. The second would be the BRICS, which would announce their new currency and say that gold is 10% of the basket. That could happen. Those two swanners would basically put a little bit of a floor under gold and silver here. The one thing that's amazing is that 1680 and 1850 are actually very solid support levels, very, very solid. But again, I don't care how solid they are. with the markets going down another 10 or 20%, I just don't see them holding.
When you see, it's kind of the golden rule that when the equities get sold off as much as they have, that you go for the big names, you get the quality. But when I look at some of these charts like Newmont, Agnico, Eagle, some of them are just now retesting the top of those March 2020 levels. But some of these other companies, I mean, they are at or below their March 2020 sell-off. And when I see something get that oversold, it makes it difficult for me to go for the quality when some of these smaller, more potential names are oversold so much. So how would you navigate that in a time like this? Is that golden rule golden for a reason, or is there, an exception to the rule in situations like this where some things are just simply too oversold?
So I've been through a few of these. I was there 2007-8. I was there in 2013. I was there in 2016. I've been through some big sell-offs. And this one. This is like the fourth major sell-off. So what I've learned is that you basically make your big money, your excellent entry points during these sell-offs. You got to look for opportunities. And so what I do is I look for miners that I don't own that are cheap. And I might also look for lowering my cost basis on some, but my primary goal is to identify miners that I don't own that have really sold off, and they're finally at a level that I can buy them cheaply. I'll give you two names right now that I'm basically going to buy. Tomorrow night, I'm actually going to buy Regis Resources. So Regis, I've never owned it because it was basically too pricey. It's never been on my radar screen because I was buying other producers. But I like to buy quality producers that I don't own that are basically at least a 4-bag. A big sell-off like this, I'm looking for 4-baggers or better. And so Regis right now to me is a 5-bagger. And so another one that I'm going to buy. So I'm going to buy Regis tomorrow night on the Australian exchange. Once the Australian exchange opens, I'm buying Regis. The other one that I'm buying next, and I'm probably going to buy it in a week or two, probably within 2 weeks, is Dundee. So Dundee Precious Metals is another 5-bagger. These are two large mid-tiers. They're both right around 800 million to $1 billion. So those type of, Regis was a $2 billion mid-tier, 500,000 ounce producer. And then I've never owned it because it was just too pricey. It was always like a 2-bagger. But now it's sold off 50% and suddenly it's a 5-bagger. I'm like, okay, I'm buying it. So the way that I invest is I use small cost basis, and I basically buy lots of stocks. I consider myself a collector. So I want to own, when this run goes to $2,500 to $3,000 gold, I want to own as many quality producers as I can, because I feel that we don't know how high gold and silver are going to go. But let's just, do some hypotheticals. If gold goes to $5,000, right? That's a kind of a crazy hypothetical, right? I'm only valuing these companies at $2,500 to $3,000. But if it does go to $5,000, what are these producers are going to do? The valuations are so high, I can't even put values on them. If Regis is a 5-bagger at $2,500 gold, what is it at 5,000? It's exponentially higher. So 10-bagger is actually too low, right? And that's an $800 million mid-tier, which is not super, super cheap. There's lots of other players out there that are going to even do better than that. So the leverage is so high, it's almost mind-boggling. Now, again, I don't try to put valuations on companies at $5,000 gold because I don't expect it. I'm just throwing a hypothetical out there saying it's a possibility. So then we look at silver. So those are the two that I'm looking at right now, Dundee and Regis, just because they're 5-baggers and it's really rare to find them. So let me give you some ideas, and also a lot of these quality producers have not really sold off. That's why I think we're in a bull market. They haven't gotten cheap as they were, like, let's say, if we go back to, I mean, say 2013, 2014, when the HUI crashed all the way down to 100. They're not as cheap as that, and they're definitely not as cheap as, say, January 2009. January in 2009, my goodness, I mean, you had, that was when these things were just insanely cheap. I mean, you can take any major, for instance, right now, and you could cut it in half, and that's kind of what we saw in January 2009. I don't think we're going to go there. We're not going that low. I mean, for instance, I mean, if we look at like some of these quality names, like Pan American Silver, for instance, Pan American Silver, I mean, it was in single digits. So we're not going to see anything like that. Where we see, I mean, it's you could look at some. So the Pan American isn't super cheap right now. It's cheap, yes, but it could get a lot cheaper if we get a big sell-off. I mean, I don't think the HUI is going to go under 170, but I mean, it's not crazy talk to think that maybe it could go to 150. If it goes down there, then you're going to be looking at Pan American. I mean, it's actually going to be sub $15. So you have to start looking at some of these high-quality names, and there's a bunch of them out there. I'm just throwing a few names out. How cheap will Barrick get? How cheap will Newmont get? Will they become 4-baggers? I don't think so. Will they become 3-baggers? Possibly. Is a 3-bagger something you're after? Evolution Mining, for instance, is a major with about $3 billion market cap. Evolution, that's a stock that could potentially become a 5-bagger here. I think it's probably a 3-bagger right now. That's a high-quality producer. I don't own Evolution. I mean, that's one that I would probably take a look at if things go nuts here. So I'm looking at, some of these higher quality. SSR Mining's another one, probably a 3-bagger right now. Potentially could go to a 4 or 5-bagger. First Majestic Silver, I mean, the risk is higher with them right now because they're actually going to lose money here this quarter. So it's kind of catching a falling knife. First Majestic, they start getting really, really valuable about $24 silver, $23 silver. They start getting really valuable. So do you buy it here? Do you wait for 22, 23 before you buy them? But First Majestic is going to look really, really nice as silver goes from 30 to 50. So there's a few names I'm throwing out there.
So that's great that you're throwing those names there. And we're also doing a little giveaway. So I'm going to have Liberty. If you can maybe just do a little number generator and find out how many people are here, and you can do the coin giveaway. And while he's answering that question, so maybe you can just do that number generator, take a small photo of the person that wins the coin, and we'll reach out to them with a DM. So my question is, what goes into evaluating these stocks for you? What's your process? Are you boots on the ground more? You're looking at drill results, and if like an accountant was to evaluate a business, how would it be different so much for a mining company? I mean, their revenues aren't the same. So how do you go through that process?
Well, it's very complex. It takes about 2 years to learn how to do it. And so I wrote a textbook basically back in 2012. I think it came out, and I've updated it like 8 times. I've kept it relevant, kept it up to date. So people can, if they read my book twice, they're going to be way ahead of the curve. And you're going to learn a lot, basically. So, for instance, today I've been talking about quality producers, and mainly gold producers I've mentioned. There's very few pure silver plays left. So if we let's just look at gold producers. So right now we're at $1,700 gold. So the average all-in break-even cost for a gold producer right now, quality one, is probably around $1,200, maybe $1,300. But I'm talking about quality. The average for the industry is probably about $1,350, $1,400. But all the names that I've listed here, actually, that's not completely true. I think Regis is not a super low cost. but you want to look, that's going to be your first thing that you're going to look at. Well, probably the first thing is a location. Location is really important because of the risk, and everybody, they want to avoid highly risky locations. A lot of people want to avoid, for instance, Africa. People, I'm not going to invest in companies that are in Africa, for instance, China, Russia, a couple other ones that avoid. So then you have to start looking in Central America and South America, and how much risk you think are there. So location's big. And then the next thing that you look at, you have to weigh it. I call these red flags. And in last chapter of my book, I talk about 10 different points that you look at. So you basically add up all the risk, but looking at all the red flags. And there's lots of different red flags you have to look at. And the balance sheet is really important. How much debt they have, how much cash. It's a cash business, so the balance sheet's really important. Regis actually has some debt, $240 million, and so and they don't have super low cost. I think like the break even right now is like $1,400. Right now that gives them $300 margin. So I don't expect gold to go under $1,400. As long as gold stays above $1,500, they're probably going to be fine. I like to invest in miners that are producing with all in the break-even cost around $1,200, $1,250, and I'm kind of okay. That's great. That's I'm not really worried too much about their balance sheet at that point. One thing I want to mention something about AISC, all-in sustaining cost, because the industry uses that term, but it's really irrelevant because no company, that's not their break-even cost. You have to pad that at least 15%. So if somebody has an AISC at 1,500, that's not good. That means that they're basically breaking even right now or losing money. So 15% is a really good number to just a general number for padding the AISC whenever you see that AISC. Although in the silver miners, a lot of time 15% isn't enough. The silver miners, you have to pad a little bit more. You probably want to go at least 20%, sometimes 25% off that AISC, depending on the company. So make sure when you see AISC, don't think that's a break even. It's higher. Again, a good rule of thumb for gold, pad at 15, for silver 20, just so you get a kind of an idea. Is this company? So right now, for instance, all your silver producers, the industry average right now is about 20, 21, 22 for the break even. So they're all, not all, but the industry average right now, they're losing money at $19. So we need to get silver back to 22 before we're kind of healthy. The gold miners are healthy at 1,700. They got about a $300, $400 margin here. So, they could gold can drop down another $100 and the industry is still healthy. We're not in that unhealthy mode, whereas silver miners right now are not healthy. But the silver miners, most of your silver miners, for instance, First Majestic bought a gold miner, but Jarrett Canyon is actually a high cost one. If you're going to buy a gold miner, buy one that has, $1,200 break even. They kind of made a big mistake there. But a Pan American, for instance, they went in and they bought some gold miners, but they were smart. Their gold miners are actually, making money here. SSR Mining was a silver miner, but they shifted over into being a gold miner. So you have to look at that. Okay, some of the other ones. Okay, management is really important. How these companies, if it's a quality gold producer, then they probably have executed fairly well in the past. You got Hecla and Coeur historically have not done well in bear markets. So you have to look at that, and sometimes you have to hold your nose. Hecla and Coeur, they tend to do well during bull markets. They don't do well in bear markets, terrible. But people are going to buy them because of their kind of a brand name. And so once gold, starts running, once it gets above 2,000 and starts running, then Hecla and Coeur will do fine because, rising tides, lift all boats kind of scenario. But they don't do well in bear markets. See, some of these companies, look at their cost. If you're going to own a high cost company like Coeur and Hecla are not low cost. If you're going to own a high cost company, you're speculating. You're hoping prices go higher. And then some of the better, more quality names, the SSR minings, the evolutions, they have lower costs. They're going to do fine in kind of any environment. But they're not going to, you're not going to get your 5-bagger. You're going to get more of your 3-baggers. You have to decide, what kind of returns you're after. Grade always comes into play. The pipeline, what type of growth they have. I'm big on that. For instance, First Majestic right now, people don't realize it's a growth story. They're going to be adding over the next 3 years, especially over the next 2 years, they're going to be adding production, which is going to give them actually more leverage. So you have to look at, what's in their pipeline, what type of growth they're going to have. It can be very interesting. Is it a growth story or not? And then you have to look for companies that have problems. For instance, right now, IAMGOLD is having trouble because they have a CapEx issue. Can they overcome that? There's a lot of risk with IAMGOLD. We have to wait and see, can they overcome it? Argonaut's another one. They have a big Magino, they have a big CapEx problem. Can they overcome that? So the risk goes up. Some companies have higher risk, but, you have to look at, what issues are they currently facing? Are they dealing with issues or not? Some companies, they're kind of on an upward trajectory. They're just kind of doing great, and they'll probably continue doing great. And that would be an SSR mining or a GCM mining or a K92 mining. These are companies that are just kind of juggernauts that are just kind of cruising. So you have to look at all the factors that go into play. So that's an overview.
So we'll get Energy has a question here in just a second, and the etiquette is if you have a question, ask to be a speaker and raise your hand. But I guess another quick one I have is the streamers. What is your kind of general opinion on these? They have lower employees.
Yeah,
it seems like they can just buy these, like in the bear markets, they can just scoop up good deals. So
yeah,
is this a safer thing if you don't want all the risk?
Yeah. Okay. So the streamers are fantastic, like 3-baggers. If gold is going to trend to 30 to 2,500, I like the large streamers. I like the Franco Nevadas, the Wheatons, and the Sandstorms. Those three. Another guy recently loved Metalla. That would be one to look at. Some of the more of the mid-tier type royalty plays. I think they make a lot of sense here on the initial run. On the initial run, I think that they're going to work, because as the price of gold goes up, their costs are fixed, and so it just goes to their bottom line. Their balance sheets are just going to explode. They're just going to do well. So I like the streamers on the first run. So when I say the first run, I'm talking about silver going from 30 to 50, maybe 30 to 75, and then gold going from 2,000 to 2,500. And maybe a little above that. Now here's my problem. So I'm bullish the streamers the first run, but once that run is over, once we get through that first run, now where's the top of the first run? Is it going to be $65 silver, 75? So let's throw a couple numbers out there. Say 65 to 75, and then for gold, let's say 2,500 to 2,700. So that's I'm going to call that the first run. Once we get that high, I think at that point, I think you should take profits in your streamers. And instead of just riding them and riding them higher and just keeping them 100% invested. And here's my argument. My argument is this: is that most of your streaming deals are fixed cost, right? For instance, most of your silver wheat and silver deals are fixed at $4 to $5 silver. In other words, that's all they have to pay for them. $4 to $5 silver. It's basically fixed. And the companies are not going to have fixed costs. So they're going to have inflation. So their costs are going to be going up. And so what's going to happen is it's going to become a one-way deal, a one-way kind of contract where Wheaton is going to just be killing it, right? They're going to be getting, so we're at $65 silver, right? And they got a $5 fixed. So they're paying $50 and they get $60 profit per ounce. right? And the company is losing money on every ounce because their costs are going up, their inflated cost, right? And so their cash costs are going to be jumping. Let's say they jump all the way to $20, so they're losing $15 an ounce on every ounce, and they're losing 15, and Wheaton's making 60. Now, in what world does that make sense, right? So they're got to get on the phone and say, "Look, this is a one-way thing. You know, we got to renegotiate. This isn't working. You guys are getting just too much profit, and we're losing money on every ounce. We got to do something here, right?" Well, some companies are going to say, "Sorry, we got a contract for the life of the mine." Well, in my opinion, I think that something's going to give here. It just, to me, I just think that something's going to give. And the model, for instance, this whole fixed cost model has to give. Now, maybe the model never breaks down, but I was giving you an example of silver, but the exact same thing is going to happen with gold, where you have a fixed price for the life of the mine, and you have inflation, and they're losing money on every ounce of gold that they have to basically mine, and then they have to basically sell it for this fixed price. I think that the model conceivably could begin to break after the first run. You know, people disagree with me and they argue and say, "No way, the model's going to hold." But I've actually talked to a few people in the industry, and they've agreed with me. These are people that are in the industry that are, you know, part of these streamers, and they basically say that, yeah, I mean, at a certain point, people are going to renegotiate some of these contracts. So if that happens, the model won't be as juicy as it is today. Right now, the model is really juicy for the streamers, but at a certain point, you know, after the first run, it won't be as juicy. What I'm saying is that, yeah, you can load up on them right now, but after the first run, take some profit. That's my opinion.
Energy, go ahead.
Hey, thanks guys for hosting the space. And I'm a little bit of a bug. I'm in a hotel bathroom, so apologies if it's echoey. I've got a 2-year-old watching a show before bed, and we're in a suite, and I don't have a fucking space. Anyway, so the point I'm getting to is, so I got into silver. I love the maples, and where it happened was I was thinking, you know what, it'd be nice to give a monster box to both boys. For whatever, you know, let's say they get married or they get a house or whatever, they graduate, whatever that thing is. So I did that, and I just did that recently because I thought silver was just insanely attractive at this point. So about physical, but for Don, you know, let's say the energy burrito has a 10% position. Let's say it's like $1 million to put into the precious metals space. I write you a check, or you just land a check for $1 million. How are you deploying that capital today? You're going to hold on to cash, or how are you investing that? And I'm sorry to put you on the spot, but it's my favorite question to ask. How would you deploy $1 million today in this space?
Okay, yeah, no problem. So I've been stacking physical silver since like 2004. So I actually hit my number. So, you know, once I hit my number, I was basically, okay, I don't need to stack anymore. That's enough. You know what I mean? It's like, okay, you hit your number, you're good. So
I'm insatiable, man. I don't even know if I'm ever going to hit that number.
So, right. I've been doing it I did it for a long time. So the $1 million, I wouldn't be doing any physical silver. But if I didn't have my number, I would definitely buy enough physical silver to hit it, right? I would basically say, okay, how many ounces do I need to, you know, for my number? What's my number? That's the first thing I would do, because I think physical. In my book, I have a pyramid system, right? And the bottom is basically your lower risk stuff, which is your physical. And so that's the first thing you buy. You basically buy your physical first. So that's the first thing. If I had $1 million and I didn't have my number yet, I'd be buying some physical. So the next thing that I would do is I would buy some producers. So $1 million, that's, you know, again, kind of your numbers, like how many much stocks do you need? You asked about what I would do, right? So I'm thinking more giving more advice for other people per se. So if it was me, somebody gave me $1 million and I had to invest it, I would definitely, I wouldn't do any exploration or developer stories, because I'm overweight that. So this would actually give me an opportunity to become even more overweight producers. So, and I would not buy major. I wouldn't buy very many majors. I might buy some smaller ones like Evolution and Northern Star, 3 million, Kinross. Those 3 majors I probably would buy. Then I would focus in on mid tiers from 1 billion to 100 million. So probably half, this is me personally, probably half of the money, $500,000, I would basically be buying producers from 100,000 to 1 million plus those 3 that I mentioned. And I would be focusing more on producers that I didn't own. Try to basically kind of fill in the portfolio per se. The other $500,000, and boy, that's a lot. I don't know if I would put that much into crypto, but it would be a chunk of that. It would be at least 100,000. So I would do 100,000 in crypto. So that gives me 400,000 left. What am I going to do with it? I got 500,000 in producers, 100,000 in crypto, and I got 400,000 more to invest. Oh goodness. What am I going to do with it? I'm ahead of the curve a little bit here. I would put it in currencies. So I would put of the 400,000, I would do 100,000 each in 4 different currencies or 3 different currencies. I'm not counting the dollar. I would definitely do the Swiss franc. I would probably do Canada just because it's our neighbor, because you can do a Canadian bank. I would probably do potentially Brazilian real. I might do Australian dollar, and then there's one currency in the Caribbean, and I forget which one that has a currency. So I'd probably do $400,000 in currencies. There you go. That's what I do.
Thanks, man. It's a difficult question. I'm sorry to put you on the spot. That's great.
Well, it was tough.
So I see we have Austin and some other people. Again, if you have a question, just kind of raise your hand. And that raised something in my head. You're one of those people that talks about cryptos a lot. There are very few people that are both into cryptos and gold and silver. And without getting too much into it, my take is that the gold people, they're pissed off that they didn't get those gains. They feel like, hey, we were supposed to get that. That was supposed to be for us. And the crypto people are irritated, and why they don't get along as well, because the crypto people say, hey, you didn't listen to us, you were making fun of us, and you were they just don't seem to get along. To me, it seems like they're people that are trying to escape a building, and one person's taking the fire escape and the other person's taking the other ladder or whatever it is to get out of the building. They're both trying to do the same thing. It seems like they would be able to get along, but they're always just arguing and fighting with each other, while the other 80% of the people are stuck in the burning building.
Well, actually, I think I know why the gold bugs don't like crypto, and that's because it's fairy dust, and it really is. It's magic, and they're like, I don't want to buy magic. Gold is real. Gold's 10,000 years old, 5,000 years old. Gold's real. It's been here forever. It's always going to be here. They don't realize that there's a lot of similarities because it's fairy dust. And I get that it's really difficult. You can't value it. I mean, if you ask the economy, how do you value Bitcoin? It's impossible, right? It's all based on belief. And so for me, I look at it as a speculative investment. And I look at gold as a speculative investment too. Gold and silver miners are speculative investment. I'm gambling. I'm betting on the price of gold and silver to go up. It's just a bet, it's a speculative thing. And so when I looked at crypto, the one advantage that I had over a lot of the gold bugs is I was in IT for 20 years, and I was a computer programmer, and I don't know, I'm full-time computer programmer for 5 years, so I kind of understand that. Kind of another 3 years as a part-time programmer, maybe more than that. So I understand coding, and I understand databases, and I understand technology. And so when I did a deep dive on Bitcoin in 2016, from the thing that blew my mind is that Bitcoin should not exist. It's a miracle. I mean, it really is. I mean, when you look at how Bitcoin came into being, nobody's ever tried to duplicate what Satoshi did. And there's never been a clone of Bitcoin in the same manner because it wouldn't work. It would fail. It's just like the fact that Satoshi created it and then walked away. When he walked away, what he ended up doing was creating a governance model that shouldn't have worked. So the governance model, since he left, there was no organization. So the governance model had to create itself out of thin air. So the governance model basically was a decentralized governance model from day one. And so the governance model evolved through basically groups trying to take over, right? Groups tried to control it, but they couldn't. So the miners tried, basically back in 2016, the miners tried to take over and create these big blocks. And the devs basically said, no, you can't have big blocks, because if you have big blocks, then you're going to lose this security model. And so you had basically decentralized. So you never had these, no organization could control it. That's a miracle, right? And so all of any clone that came after, like Litecoin, it couldn't existed by its own. So you had the Litecoin organization that was built around it. Every clone that came after Bitcoin has a quasi group that basically has too much influence over it. It's not totally decentralized like Bitcoin. So it's a miracle. It shouldn't exist. You can't kill Bitcoin, but it's fairy dust. The reason why it's fairy dust is because, what is Bitcoin? Trying to define Bitcoin is actually impossible. I define it as a collectible. It's basically like a Wayne Gretzky card that you have a digital ownership. You have a partial ownership of it. So there's like 21 million ownership if you have a full Bitcoin, but then there's 8 decimal places. So you take 21 million times 8. Those are all the pennies, right? The Satoshis. And each one of those is like an ownership of a Gretzky card. So you break the Wayne Gretzky card and you break it up into 21 million times 8. And then all those digital ownership, everybody can own a Satoshi, but nobody can really own a single Satoshi because that's less than a penny. So let's take it up to like a buck, right? So you take a few decimal places off. So you can basically trade 21 million times 6, for instance. And that's how many Satoshis are out there. You take that one card, you take a Bitcoin, and you break it up into all of these little digital pieces, and those are the collectibles. And what people don't realize is that we don't know what Bitcoin is worth. People that say it's worth nothing, they're guessing. People that say it's going to be worth $1 million, they're guessing. We're all guessing. It's speculative. So I use crypto as a hedge against my miners, and it's worked out great. And I still see it as a good hedge. And so that's why I would basically take $100,000 and buy crypto, because I'm hedging against gold. And I think that if Bitcoin ever gets to 6 digits, if it ever becomes worth $100,000, at that point, I believe that gold and Bitcoin will fight it out as the preeminent SOV. Because if Bitcoin survives, it's going to increase in value over time at potentially at a higher rate than gold. So if that's the case, then it's the SOV.
Yes, and again, I got tired of fighting it. I was against it and at $100, and I just gave up and said, "All right, just have some, and it's either going to $1 million or zero, one or the other." It feels binary. Just it's gonna do one or the other. You might as well have that lottery ticket. And this last cycle was just completely nuts. The NFTs and everything, and the Luna. I guess energy too. You can go ahead and put your hand down for a second, but we're kind of curious too with gold and silver. Is that the main metal that you are into? Do you ever look at other things like copper, uranium, or platinum, or is it just mainly the gold and silver that you're focusing on?
Yeah, just gold and silver only. I've always been somewhat bearish base metals because I see that the American era is ending. So if the American era is ending, I don't see a lot of really strong economic growth anywhere in the world. It's basically I see sluggish growth point forward. But at a certain point, I think there's going to be shortages of these base metals, but I don't see it happening like in the next 5 years. Most of these shortages, I think, are like the end of the decade, and I see myself out of gold by then. I see myself out of the miners by like 2025. I see this next run is really where I'm going to make my money. Now, as far as crypto goes, my cost basis in crypto is only 6%, which is relatively low. And the reason why it's low is because I got into Bitcoin cheap, and I got into Ethereum cheap. And so I've never had to have these big, outlays to buy crypto. And so I've always tried to buy crypto as 50 baggers. So my gold miners, I'm looking for 5 to 10 baggers. You cannot pick a 50 bagger in miners. It's impossible. You get lucky. If you buy a 5 bagger, and all your 20 baggers, 20 to 50 baggers, in my opinion, in miners are just luck. They just landed in luck. I'll give you a perfect example. So I bought Crocodile Gold. When it was cheap, right? People are listening to this don't even know what Crocodile Gold is. Crocodile Gold is who owned the Fosterville mine that Kirkland Lake bought. So my cost basis in Kirkland Lake was like $3. And now I own, and it went to, I don't know, 40, 50, right? And I still own it because Agni Eagle pays a good dividend. So I held on to it. So that one is going to turn into, it was a 15 bagger. It's going to turn into a 2025. It's all luck, right? I buy Crocodile Gold and, turn it into the Fosterville mine. So you just get lucky on those. With crypto, I only buy cryptos that I think are going to be 50 baggers. So, they're basically total, and that's why I only have 6% cost basis. If you're going after 50 baggers, 6% cost basis is fine. It'll probably grow to 7%. I don't think it'll get to 8, but it might. But that's all I do. I do crypto and gold and silver and physical silver.
Okay. So, Liberty, I don't know if you want to let us know who won the contest or if you have some more questions. And again, if anyone else has a question or, about a specific mine or something like that, raise your hand and kind of speak up. But I'm really curious about your opinion on, the Pebble project. So it just seems like that one just has tons of stuff in the ground, and there's just it shoots up like crazy, then it goes down, and it won't it, and if we have an administration changes. So just the general opinion on that one.
Yeah, I've always been negative on Pebble because there's too much risk in the permitting. You have to weigh the red flags. Why are you going to tie up your money in a project that's not permitted, that has permitting risk? It just makes no sense. Plus, the CapEx is huge, so we don't know how they're going to finance the CapEx. CapEx can always, depending on how a large CapEx is financed, it can really hurt the investor, the shareholders. They could have a huge streaming deal, and the streaming deal can be very painful for shareholders, and management doesn't care. They just want they're going to have a 20, 30 year mine life. They're going to get income every year. They're going to get salaries. So I'm always negative on these really big CapEx projects, unless they get super cheap. And the other thing is the timeline until they get permitted. So yeah, Pebble, I've always been negative on it until two things have to happen before you want to really even jump in. Number one, the permitting has to be completed. It has to be done. You want to wait until that. And whenever there's permitting issues, don't just bet that it's going to get permitted. The risk is too high. And then in the second one, you kind of want to wait until see how it gets funded. Now, sometimes another one, like Seabridge, for instance, they have, their project is just massive, but, how is it going to get monetized? I don't know how it's going to get monetized. So I don't own Seabridge and I've never been interested in it. Their project, I don't know, it's massive, 40 million plus ounces of gold, but how are they going to monetize it? Are you going to get a 3+ bagger? If you buy Seabridge today, are you going to get a 3-bagger? I don't know. Northern Dynasty, are you going to get, a 3-bagger? I doubt it. It's just the risk reward's not there. So now once in a while, I will gamble on a large CapEx project if it gets super cheap and I think it's going to get permitted and, you roll the dice. So I'll give you one example, and that's International Tower Hill Mine. I've followed International Tower Hill Mines for 15 years at least, and I've never owned it until this year. So there's my patience. Now I've watched this thing for 15 years, and now it's finally, I think, gotten the risk reward has finally gotten there where it kind of makes sense. So let me take a look at the current market cap. So the current market cap on International Tower Hill is $111 million. So it's a 16 million ounce project. So how much are you paying for 110 million? If you're going to pay, that's less than $10 an ounce. It's about, 6, 7. So if you're going to pay, if you can pay, $10 an ounce, and it's finally getting, closer to the permitting process. So it's starting to get interesting. I think it's going to start moving around 2024. The permitting should be completed around 2025. So it's about 3 years out from being permitted. You got 22, 23, 24. So it's still not super juicy, but it's a 350,000 ounce project, I think, and it prints as a 25-bagger. So I rolled the dice on it this year. So it's not super great, but I like it a lot better than Northern Dynasty.
While we're on the topic of permitting, it seems like there's a lot of new jurisdictional risk change, specifically like some of these Chilean mines. I think just as many as 6 of them were recently snubbed. Can you speak to that? Is there a change in this dynamic here? What's going on? Can you speak to it?
Yeah. What's happened is South America, if you will, has always had a political problem. And the political problem is that they've never had a moderate type of political system that works. So you tend to have either conservative or left. It's either left or the right. And so they go in cycles. It doesn't seem to matter. Every single time we see a far left, we saw it in Bolivia, we saw it in Ecuador, we saw it in Venezuela, we've seen it in Argentina a few times. Every time they try, we saw it in Nicaragua. Whenever we see a leftist model, it fails, but it doesn't seem to stop them from trying again. So we saw it actually in Brazil, and now looks like it's going to come back. So the leftist model tends to rotate. And it's not dead. It's not dead in South and Central America. Even though it always fails, we still see this rotation. We just saw a leftist get elected in Colombia. We saw a leftist elected in Peru. We saw one. So right now we saw 3 leftists elected in the last 12 months. Peru, Chile, and Colombia. So we see, and so basically what that tells us is that the leftist model is not dead in Central and South America, and it's somewhat on an upward slope right now. It seems to be kind of trending. Like right now, I forget. I'm thinking I'm going to wreck his name. Bolsonaro, the guy in Brazil, is probably going to lose re-election to a leftist. The guy that was there before. So we're going to get another leftist in Brazil. So this is not good for miners because the left is never positive. They talk about nationalization. So right now, Chile and Peru are actually somewhat, the risk levels have increased. The risk levels increased in Colombia as well. So it's not good. I think that Mexico is another country you can no longer consider it a mining friendly country. We've seen some issues with Fortuna having trouble with their permitting. So I think on the whole, I think that Canada and Australia are actually becoming two of the better places to invest your money for miners. And everywhere else in the world, you got to cross your fingers. So that's the trend right now. The trend is not our friend as far as mining friendliness goes. A lot of people are starting to think in terms of mining as being anti-environmental, green, anti-carbon. It's like, mining is becoming, somewhat of a kind of a black eye as far as the enviro green movement goes. And I don't see that turning anytime soon. So it's another risk factor for investing in miners.
Let's see. Energy, you had another question, buddy? Okay. If not, I do want to follow up with you again. We had spoke about the physicals earlier, and we were trying to figure this out amongst ourselves last time. Listen, if you have a new investor who's trying to buy some physical metal, who maybe just be getting into this, when you look at the premiums, silver round, silver bars, 75% premium, or excuse me, for 25% premium, as much as 75% for Eagles. I mean, you're a couple of dollars away from being double spot. How do you factor that in when you look at the silver to gold ratio and you say it's 90 to 1, but after you factor in the premiums, even the premium on gold, it's more like 60 to 1 or 70 to 1. Do you look at it that way, or is it just the way life is now and we just need to deal with it and get it now before the premiums get even higher?
Yeah. Somebody asked me this yesterday on my website's forum. What do I think? What are the premiums going to do? I don't think they're going down. I think the high premiums are with us for this cycle. Right? When I think this cycle is going to last a few years. I think that you're going to have more physical demand point forward. I think we're going to look back in history and see that March of 2020, when COVID hit, was a game changer for the world, if you will. It was a transition point into a new era, and that kind of the lunacy of MMT kind of raised its head and showed us that these central banks no longer care about sound money, and so if they don't care about sound money, then the precious metals are going to basically benefit from all that money printing. And I think that once we go over $2,000 gold, I think that's going to be a big signal. It's going to be a big red flag that basically the currencies have kind of broken, if you will, and that people are going to want to own more gold and own more silver. And I think $40 silver is probably going to be another kind of big flag signal that things have broken and that I want to own it. And especially as we trend above $50, I think more and more your average people, they can't really afford 1 ounce gold coins at $2,000, but they can afford silver, and so you're going to see that. And so I don't see the premiums going down. I actually talked about this back when the premium was really low. I used to tell people that junk silver was going to have 100% premium once it's gone. And we're already starting to see that now. The premiums, we're not at 100%, but the premiums on junk silver are starting to be the equivalent of bars, and they used to be below that. So we're looking at 30% premiums on junk. I think it's going to go to 100% premium once it's all gone, once you can't find it. And so I like junk silver. I was something that I stacked some because I that was my feeling that premiums were going to go absolutely nuts. So if junk silver was going to go to 100% premium, what's that going to do to bars? Bars are already at 30% premium. I think you can find some bars, silver bars at, especially gold bars. Yeah, you can find gold bars at 8%, 10%. But I think they're going to go up. And I think silver, especially, I think silver premiums are going to kind of go nuts. So it's going to be difficult to find. I don't know if Eagles will go nuts. They're already nuts, right? I think they'll just stay high. But I don't think we're going to see low premiums anytime soon. So yeah, so if silver under, for me, the number price for me for silver was always $18. That's out the door. If you could buy silver under 18 out the door, you were basically buying it really, really cheap. And so anything from like 18 to 25 is still, not a bad price. I want to buy silver under 25. You can actually buy silver under 25 right now. You can find it out the door under 25. It's not easy, but you can. And so we're kind of at that. We're kind of in the last period, I think, where you can actually buy silver relatively cheap. I don't think it's going to be much longer when you cannot buy silver under 30. That's my gut feel, is you won't be able to buy it under 30. And that's not that, and you're going to be paying these high premiums. I remember when you could buy silver, bars at a 5% premium. An 8 was common, and I don't think we're going to see that again. If you can find one on sale for 10%, you're real lucky.
So how long do you see this cycle lasting, as far as 2 or 3 years, and do you see silver going up higher than gold during this next few years?
No way. Yeah, I think that my fingers are crossed. It's hard to predict, right, how long this cycle is going to go. I mean, some people think it's going to peter out here. The cycle. We're going to go back to a 2013 scenario, and everything's going to crash, and we're not going to see $30 silver for 10 years. I think that this cycle is going to, the bull market is going to resume next year, and I think it's going to last about 2 years. So 23, 24 is 2 years. If we get lucky, it lasts through 2025, and that's 3 years. A 3-year cycle would be fantastic. And then we get some type of significant correction. And then the correction could be nasty. And then the correction could be like 50, 60, even 70% down. That's typical. And then then perhaps we may make another run towards the end of the decade. It's hard to really predict, but I think my hope is that this run is it lasts at least 2 years. So 23, 24. And that during that 2-year run, that gives us 8 quarters. So if we get 8 quarters of high silver prices, the producers and the miners should do really well. Because 8 quarters, that's basically 8 quarters to fix their balance sheets. 8 quarters to basically look really sweet. 8 quarters to basically pay really high dividends. If we don't get 8 quarters, I'm going to be very disappointed.
We got some hands up. Go ahead, Austin and Energy.
Hey, Don. So on that point, that actually ended up being a perfect prelude into this question. So in the last cycle, most of the major miners, especially on the gold side, they just plowed those profits into enhanced production, right? And I'm not even going to say what happened, because it's probably rubbing salt in the wound to all of us, but the market did not treat them kindly on that. One, how do you expect that, let's say more on the gold miner side, where like the producers, the balance sheets are shockingly good. Like, what do you expect they're going to do? And two, what do you want them to do? Like, what do you think between dividends, buybacks, acquisitions, exploration? Like, what is the market going to reward? Thank you.
Yeah, I think it's a good question, and I think it's really pertinent. And I hope that the mining industry doesn't act like fools. And if because it's really easy for them. When I say act like fools, I'm basically talking about, basically business as usual, if you will. This is a once in a lifetime bull run. And if it's a once in a lifetime bull run, you should treat it as such. And if they act like fools, if they act like this is going to end tomorrow. So in other words, the run begins, right? We go to $40 silver. And we go to $40 silver and they act like it's going to go back to 20. And they basically, they don't fix their balance. They don't basically, pay off their balance sheet, and they act like everything's normal. So they don't try to pay it down. They don't try to become. So the way that you add shareholder value, I think, is obvious. And the way you add shareholder value is you do what Kirkland Lake did. And what Kirkland Lake did was they basically built cash. They basically added, I forget how high they had their cash, but it was well over 500 million. So they had like 500 million in cash. They had no debt, and they maintained their low cost. They basically didn't damage their, they were generating cash. So they had 500 million in cash, and they were generating cash because they had low cost, and they didn't damage the model. They didn't go out there and buy a high cost producer. They didn't damage the model, and they kept adding cash, and they started paying dividends. So what happened? Their multiple went to 25, right? And their multiple prior to that was like under 10. And so their model, they showed what builds, what creates shareholder value. And that's basically generating cash, having a very strong balance sheet, and just looking just very, very strong. So other companies can do the exact same thing. So if gold and silver start trending higher, what they should do is basically pay off their debt, get rid of their debt, and start building cash. And so if they do that, their multiples are going to explode. I think the multiples, so Kirkland Lake's multiple was at 25 when gold was like 1,600. So what would their multiple would have been if gold was at 2,500? Their multiple would have went to 35. So it just shows you that's the model that works. The model that works is get rid of your debt and just add and just build cash and pay a big dividend. And every quarter increase your dividend. If you do that, your multiple is going to go to 20, 25, 30, 35. So when I say don't act like fools, if I'll give you an example, is Hecla and Coeur. They always have a lot of debt. If Hecla and Coeur go, this is our chance to basically change our model, pay off our debt, and add just a boatload of cash. If they did that, if Coeur basically, or Hecla, either one, if they get like 500 million in cash and have zero debt, and they're generating, a ton of free cash flow. So at $2,500 gold, their all in is going to be around, if gold is going to be around 1,500, right? So they're going to be generating $1,000 an ounce in free cash flow, and they're paying a high dividend. Their multiple is going to jump to 25 to 30. That's what I mean. Don't be foolish. Know what works and do it.
Awesome, thank you. And real quick on that, let's just say that you're the CEO of Barrick. They have a net cash position right now. Are you keeping that cash? Like, are you basically taking the cash, or are you keeping the gold on your balance sheet and not selling it?
Well, the big major like Barrick and Newmont, they're going to act like fools because they're just so big. It's called hubris. Hubris is basically where you're arrogant and you think you know better than everybody else. You think you're the smartest one in the room, right? And so Barrick and Newmont, they won't, what I just explained, they won't do it. They won't because of hubris. They just, they're the biggest producers out there. So they think that they can have a lot of debt on their balance sheet. It's just we can have a lot of, we don't have to pay our debt off. We don't have to, right? That's the hubris. In other words, we don't have to build shareholder value. So they won't do it. But someone like Coor and Heckler, they could basically, their management team could basically say, look, this is an opportunity for us to build shareholder value. And we know how to do it, right? If I'm in that room, I'm basically saying, look, guys, we can take our multiple up to 25 to 30 if we want to. Does everybody want to do that? Is that the smart thing to do, right? But in Barrick, they won't even ask that question because the hubris. And not one shareholder, not one board member will raise their hand and say, this is what we should do. Not one will do it because of hubris, right? But so the big ones, anybody that has a market cap of 10 billion or higher, I find won't do it because of hubris. They won't do it, even though it's the smart thing to do, because it's basically a contrarian type of thing, right? It's contrarian. It's like, oh, let's just be shareholder friendly. Let's go and do it. A good example is Apple, right? Look at Apple. You know, they actually added some debt. In my opinion, it didn't help them. Look at their share price right now. It's stuck because they went against it. But remember when Apple was just going absolutely nuts, when they had 500 billion in cash and no debt. Everybody wanted to own Apple, and they were just going nuts. And then they started borrowing money like idiots. The hubris made them borrow money. You never should borrow money unless you can pay it back quickly, in my opinion. If you have 500, let's say you have 500 million in cash, and your free cash flow is 500 million a year, right? Then you can go and borrow 300 million. You can pay it off in 2 years. You can go build a mine with 300 million in capex, and you can pay it off in 2 years. That is smart investing. That is how you don't hurt your share. You basically say, look, we're going to borrow 300 million. We're going to pay it off in 2 years. The share price will not go down at all, right? So that's the smart thing to do. But again, these big market cap companies, they're just too arrogant. They don't really care about the shareholder per se.
Don, I'm sitting here nodding my head, and you can't see it. And if you can't tell, I'm into the energy space, and the companies that I like generate in this environment, like 30% free cash flow. And there's always the argument. It's like, oh, is it going to be NCIB? We're going to jack the divvy. What are we going to do? And that's such a simple answer. What if we just sat with 30% cash on the balance sheet? Like, you have to value the business properly that way. Like, don't sure, have a dividend, do some NCIB or whatever, but you're right with the Apple analogy. It's brilliant. I never thought of it from that perspective. And in these like boom bust sort of environments, why not sit on, if you're a $5 billion company, why not sit on $1 billion in cash and see what your business is going to be valued at in the public market. So I'm not trying to put words in your mouth, but like in the energy space, would it not make sense to just stop playing games, just jack your balance sheet, and then have the multiples increase?
Well, the thing that's beautiful about having a chunk of cash on your balance sheet is that you're guaranteeing an increased dividend every single quarter. And that just increases your multiple. It just creates a floor under your share price. It's like you can have a bad quarter and you're like, okay, I still got all that cash, so I'm still going to increase my dividend. And that's the reason why Kirkland Lake just went nuts, because they were increasing their dividend every quarter. And so they just kept going higher and higher and higher. And simultaneous to that, they could use that, they can leverage. The other thing that's beautiful. So the energy space is also cash intensive because it costs a lot of money to basically maintain your reserves. I worked in the oil and business. I worked for Chevron for 9 years. So yeah, I mean, you got to spend a lot of money to keep your production up. And so it's a cash intensive business, just like the gold and silver industry. So the thing that's awesome about the gold and silver industry, when you have a huge balance sheet like that, is that you can leverage that cash. It's a beautiful thing, and nobody wants to do it because, it's contrarian. It's like, no, I don't want, they prefer to have a lot of debt on their balance sheet. It's like, yeah, let's do that. But I don't like it.
So I see we have Kevin joining in. If you have a question, just raise your hand. I kind of have a little bit of a different type of question. Is what do you think about these business models where they tend to buy like these companies like Gold Mining Inc. and well, what's the other? There's another one, First Mining Finance.
Yeah.
They tend to buy.
I love this question.
They tend to say, "Oh, well, look, we got all these mines. They've already drilled them. They've already done these results, and they just collect them. So, are they going to do anything with them? And what's the danger for someone kind of to add up all the bones? Does that build an animal, or what are your thoughts on those?"
I love that question because I have an MBA, and so I understand that each business has to create a strategy that leverages the company to the best of its ability. And so and the other thing that I learned when I got my MBA was that a business, it's their responsibility to figure out what is their best strategy, right? And if you don't figure it out, you're basically ignoring your shareholders. And so I see this all the time. It's like, what is, and I actually, argue, I'll interview CEOs from time to time, and I'll argue with them, basically saying, your model, that's the wrong model. That's not the best model. Sorry. I'll argue with them. So because because their current strategy just does not make any sense for the shareholders. And I'll give you some great examples. Gold Mining Inc. is a perfect example. They do not have a strategy. They don't.
Well, welcome back, sir. Sorry about that technical issue. The space crashed on us.
Okay.
So again, what we're trying to do is really just create a weekly space, and it is a new feature on Twitter, but where the metals and mining people just kind of come together, hang out, whether it's a coin or 10 baggers, what we're talking about. So that's what we're really trying to do, is just have this be the weekly spot. And you've just been an excellent guest.
Thanks.
So we cannot thank you enough for coming in and sharing your thoughts and experiences.
Truly.
So we'll most likely we'll just have you kind of finish your thought. And again, we're recording this, so it'll be on YouTube as well a little later. But you were kind of talking about the company Gold Mining Inc. and what your thoughts were for them. So you might, if you don't mind starting over on that little rant.
Okay. Yeah, I'll redo it. So part of it's going to be a duplicate. So one of my pet peeves is when I see a company that I don't think has the best strategy for their shareholders. I feel like it's more of a strategy for management. They basically, they're taking the easy road, if you will, because mining is so difficult. So maybe I'm a little harsh. Maybe my criticism is a little harsh because, it's not an easy industry to do. But for me, it's more of it's the right thing to do. So for instance, Gold Mining Inc. Their strategy to me didn't make a lot of sense when they did it. It's like, what are you going to do? So they're basically, buying up advanced projects, projects that have a lot of gold in the ground. And then it's kind of like, more of a holding type of company. But if you do that, then what is your strategy? What are you going to do with those projects? And they never, coherently explained exactly what they were going to do. They just bought them all up. And the share price, never really did amounted to anything. And then last year, I think it was last year, they spun out, they created a royalty company, and then they spun out a lot of the royalties from these projects that they owned. So that was one way, but they didn't give shares in this royalty company to the people that owned Gold Mining Inc. So if they were going to benefit shareholders, they would have done that. So they spun out a company, so we all get a piece of it. Instead, they gave those shares to Gold Mining Inc. and not to the individual shareholders. Basically part two of, not really the best strategy for shareholders. So for me, if they would have just taken one project and said, okay, this is the best one, we're going to develop it. And then we're going to develop all of the others, kind of what First Mining Gold did. They basically realized that, wait a minute, our strategy isn't really that great. We need to figure out a better one. So they decided, let's just take our best project and go and develop it. And they are. And then once that project becomes de-risked, I think shareholders are going to benefit dramatically. So Gold Mining Inc. should have done or should do the same thing. So it's kind of disappointing they're just sitting there on these projects. And I see this a lot of times with project generators. They have the potential to basically shift the strategy now that the company is kind of pivoted. For instance, Mag Silver, they own a little over 40% of Juanicipio, which is probably the best silver mine in the world, and it's basically ramping up production right now. So what kind of a multiple is Mag Silver going to get if all they do is pay out a dividend, versus if they took all that cash flow, put it on their balance sheet, and then leveraged it via building another mine. So they have the cash flow coming in. Now let's take that money and buy a development company and build it into a mine, and then build a third mine. So then they take all that cash flow keeps growing. So they would have the initial Juanicipio, which is over like 20 years, and they can leverage that 20 years of cash flow into building a bigger company. I think that makes a lot more sense. So I see that from companies, once they get a big chunk of free cash flow, if they're an exploration company, how are they going to leverage it? And I think pivoting into a producer, I think, makes more sense to shareholders. So that's kind of my answer for Gold Mining Inc.
So I hear a lot too about everyone's aging out of the mining business. So who do you think are the next superstars, the young guys that are wants to watch the good management teams that kind of just pop off the top of your head that you want to be involved with, and when they're in that project, you something's going on.
Yeah, amazingly, this list is actually shrinking instead of growing. Oh gosh. I mean, back in the day, we used to think that Rob McEwen, anything that he touches is going to do great, right? And then of course you had Rick. You had First Majestic. How come I can't think of his name?
Newmont?
Newmeyer.
Keith Newmeyer.
Keith Newmeyer. I should definitely know his name. Newmeyer lately, he kind of stubbed his foot on Jarrett Canyon. He was like, oh, that was kind of disappointing. And then the guy behind the Pure Gold, all those companies that were named True Gold and Liberty Gold and all those, I used to think that that guy was walked on water, and then Pure Gold kind of blew up. It's like you bet on these people and then they fail, so it's kind of hard. I think Ross Beatty. I think I like betting on him. I think he's a pretty smart guy. The Lundin family. I don't know how to pronounce it. Lundin. They're pretty smart. I think they know what they're doing. The new guys that are behind I-80. I think I-80 is. I'm impressed by what they're doing. They seem to be executing really well. But by and large, it's really difficult to find a team that that I really like. I don't really like conservative teams like SSR Mining. I mean, yeah, they've executed really flawlessly, but they tend to be a little more too conservative for me. IM Gold is, they made. I don't really think it was their mistake per se. Their capex exploded. I like IM Gold's team. I like how aggressive they are, but right now they're having trouble. But I tend to like I-80 is an aggressive management team. Equinox, it's Ross Beatty. I like Equinox's aggressive style. I prefer growth teams. I think Evolution Mining's management team has done fabulous. So I look at execution, see how they're doing. K-Rora is, I think they did a really good job building their mine, but they've been getting beat up lately. I want to see what K-Rora does next. I kind of like their team. And so I look at how teams execute and see what they're going to do next. Minera Alamos, I have high hopes for them. I think they have a good team. So I look at some of these executors and see how they're doing. GCM Mining, I think they're a really good turnaround story. I mean, initially people hated them, but wow, they've executed really well over the last 5 years. So I like GCM. I think they're going to do okay. Jaguar Mining to me is just way too conservative. I mean, come on, build a second mine. Silvercorp is another one, just way too conservative. Come on, build another mine. So these companies that kind of sit on their mines and don't grow and don't build, I don't like that. I want to see some growth. I want to see, what's next kind of thing. So I look around, see how they're executing.
So what's a team really do besides not dilute and pay themselves too much, though?
Well, yeah. The key for me is building another mine like Argonaut. I mean, Argonaut, they built like 4 mines. You build I-80s like 4 mines. That's what I like to see. I like to see these companies that just keep buying and building. Magino really bit Argonaut, but they've been executing really well. But now they're kind of in my doghouse. They got to figure it out. I don't know how. Argonaut right now is kind of become a speculative play, but that's what I look for. I look for companies that are buying and building. I do not mind. Fortuna, when they bought Rock School, I thought that was a fabulous acquisition. But they've been beat up. They're undervalued because the 2 mines that they bought were in Africa, and people weren't really excited about them. Perseus Mining is another one, really good. They execute really well. I like them. Endeavor Mining, but they're big, but they're good executors. Those are kind of the 3 that I like. Osino, I kind of got my fingers crossed that Osino has a really good team. We'll see how they do. But a lot of times you have to cross your fingers early and see how they execute. I like a lot of the miners in Australia. I talk about Regis. I think Regis has a good team. We'll see how they do. West Gold, I think they're going to do okay. Karora. We'll see how they do.
You're getting me pretty excited. I'm invested in a lot of these teams that you're kind of bullish on, so that's kind of exciting for me.
That's why.
What about some?
That's why.
Yeah.
That's why you own them.
Yeah, that's right. Well, what about some of the teams that have failed projects? There are some recent golden child kind of projects, you might say, that have rolled over, like Aurcana. Can projects like that be saved? Right,
no,
with a new team.
No, it's been lately. It's been a nightmare. The last 2 years, 12 months, it's been really bad. Aurcana, yeah, I think they're done. Walloona looks like they're done now. That was they had a lot of gold in the ground. How did the Walloona screw up? I mean, they had a ton of gold. And then you got
Yeah.
Great Panthers just hanging on by a thread. You know, their management team is really, you know, they really messed up Toscano. Yeah, and very disappointing. There's been several Pure Gold, of course. I think Pure Gold, I think they're a turnaround story. Tony McCooch, I think, you know, I like him a lot. I think he's going to turn it around. I actually bought the dip. I bought the bottom on them. Gatos basically had a really bad, you know, their resource. They're redoing the resource. You know, it's crashed. I'm hoping Gatos.
Right.
I'm hoping Gatos turns it around. It's another one. But yeah,
Yeah. What is your opinion on that one? Because I was a holder there and I got hurt pretty bad.
Yeah, I bought it. I bought the dip at $3. I'm a fan.
Okay.
I think they haven't. They got 5 years to expand. You know, to extend the mine life, and then they have enough. I think they're going to have enough free cash flow. Right now, you know, it's kind of a risky stock at $19 silver. You know, their break even's probably 2021, so that's not good. But I think they have enough gold. I'm bullish. I think they're going to figure it out. But fingers crossed. You never know. I wish silver was at 27, 28, and we wouldn't be worrying about these companies.
So what is the all-in sustaining or
Break
all-in
even.
sustaining cost? Yeah, break-even point for. Oh goodness, I kind of messed up when I said it, but the all-in sustaining cost for most miners.
Yeah, I actually answered this one earlier. So for silver, it's around 21, 22, the average, industry average right now. There's not a lot that are 20 or less. The average is somewhere between 21, 22 for and there's not that many. I mean, there's like 25 silver miners. It's just they're just disappearing left and right. So for the gold miners, it's around 1350. I would say is about the average for the industry. So we have you know, we have a lot of marginal, you know, gold would have to crash down to 1450 before any of the majors have a problems. Some of the mid tiers might have a problem at 1450, but do we really expect gold to go to 1450? No, we don't. So the majors are all fine right now. It's a matter of just buying the dip here on them. Very few majors don't have a break even at 1350 or below. I mean, there's a few at 1450, but not that many under 1500. Actually, I did a list today. I actually posted one of these are miners that are above $1,500. There wasn't that many.
So I see Jim just joining in. I don't know if you have a question or not. You can raise your hand or ask Don if you want.
I do. Thank you very much. Hi, Don. Jim Hunter.
Hey, Jim.
Don, can I please ask you how you feel about GDX first? And then there's a couple of leveraged plays on GDX. One is NUGT and one is GDXU. Can I ask what your opinion would be there?
Wow. So inside of GDX, they've actually put a couple of leverage plays. They actually have holdings of leverage plays.
Well, the symbol NUGT, NUGT, it's a Direxion 2 times GDX. Effectively, it used to be 3 times. Now it's 2 times. And then the other one is GDXU, and that's a 3 times leveraged instrument. If you want to take a look at those over the next week. Go ahead.
Yeah, but they're not actually inside GDX. They're just leveraging GDX, right?
Yes, sir. Yes,
okay. Yeah. Yeah, I thought okay. So I don't like to use those unless you're trading. So the leverage plays, I think, make a lot of sense for like daily and weekly traders, but I don't think they make a lot of sense long term, because it's just, why add that risk? I prefer to be more of a long-term investors, but they make sense as a trader if you like to trade. So GDXJ. So I prefer GDXJ over GDX. I don't really see a lot of reason to own GDX. I think GDXJ is a very, kind of as far as risk goes, I don't think that it has more risk than GDX. So why, if you're not going to have more risk, why own GDX? That's how I've always looked at it. I own GDXJ. I think it's a good way to have exposure of like a three bagger with low risk, relatively low risk over the long term. Now you are paying like 0.5% annual fees when you own it, but I like GDXJ. I think it's a good way to get exposure to have for significant allocation. For me, I don't like to allocate more than 1% to an individual stock. But for GDXJ, I don't mind having like 3% of my portfolio, because I don't think that I'm really taking a lot of risk there.
All right. Could I ask you one more, please? Would that be
Sure.
okay?
Sure.
All right. About 4 or 5 years ago, Mr. Morgan came out with as a follower and a stock that he really liked, of a company that's got a direct competitor to using a process that used to use cyanide, and they've got an inert product that they say you can almost drink it. You can't drink it, but you can leach out of electronic waste, or they've even got a test going now with its in situ mining, where they inject it in the ground, they let it sit for a little bit, then they pump out the fluid again and put the fluid that's rich in gold through a process to redeem the gold. Are you familiar with that company?
I am not, but interestingly, you bring that up. There's a new company that I just analyzed. Let me find it here. Where are you? How come I can't find it?
The one I'm talking about is a Canadian company. It's very small. All it's done is retract and share.
All right, so I found it. It's called Enviro Gold Global. Have you heard of that company?
Well, the one I'm talking about is called Envirometal. So
okay. So Enviro, so the one that you are talking about, they actually came up with this new technology. Now, I would say that it's a spec bet until they basically prove it. But this other company, Enviro Gold Global, I just added it to my database this month. And they have an interesting strategy that I've never heard anybody ever do before. They're basically buying up projects that do the tailings. They buy the tailings.
Sure.
And then they process the tailings. And so what they do is they go to a company that has a tailings pond, and they basically say, look, let's do a 50-50. It won't cost you anything. We'll process your tailings for you. The company's basically hasn't processed their tailings, so they got just basically tailings just sitting over there in the corner. So company just started. So if they could use that new technology, I don't know if they are, but it's a new company. But I just did the analysis on it. Enviro Gold Global. It's super cheap. The market cap on it for what they plan to do. So the capex, for instance, is going to be really low because it's, they don't have to, the dirt's just sitting there ready to be processed, right?
They're just going to go after. They're going to try and find gold in stuff that was missed in the plant.
Yeah. So
in the process.
Yeah. So it's going to be very low capex, very low permitting, very quick permitting. And they just basically make a deal with the company that owns it and says, okay, we're going to, how much, and it's hard for them to turn it down. So their first project is a 50-50 deal, but they have like 7 or 8 projects that they're trying to make deals on. So it's a really interesting model. I've never heard of it before. Just go around and find these companies that have tailings. And they claim, this is really interesting, they claim that globally there's like $4 trillion in tailings just sitting there.
Okay.
So it's an interesting little project. So I actually have heard, I think, about this before, this technology. I don't know if it's been used, but I would be leery until it's actually been proven. But this, I would look into this Enviro Gold Global, it sounds really interesting because it's super cheap right now.
Would you like the symbol on the one I'm talking about to at least take a look at it?
No, once they basically
understand.
once they start using the technology, I'll hear about it at that time. But I focus on miners. I don't focus on offshoots or niche companies. I would be much more interested in Viral Gold Global that it's using the technology.
I understand. Thank you.
Yeah, sure.
What about what Frank Giustra is doing with TMC Metals?
What is it?
Well, they're essentially vacuuming on the ocean floor for all the minerals down there. Essentially, the ocean floor is covered with all these nodules, and it
Oh,
is just nearly unlimited resource of mostly battery type metals. Um, but they're essentially it's just a little scooper like when you go hit practice range golf balls and they come and scoop them up with the cart. It's the same thing, but it's on the ocean floor. It scoops up all these nodules, and it's massive resources down there.
it definitely sounds interesting. There was actually a company that went bankrupt that was trying to mine the ocean floor. Do you remember that company? It was about 10 years ago. They went bankrupt. They actually had a market cap at one time over 100 million. I forget the name of it.
When it started as a SPAC, it's now TMC Metals, and I was really interested in getting in on the ground floor, and it was a company that Reddit got involved with, and it ended up just getting completely nuked. It started at $10, and then within a couple of weeks, it was all the way down to a couple bucks. But I've always had my eye on it as an interesting technology for the potential future of mining, and they claim it's very green. It's
Oh yeah.
but Frank Giustra, he's a big name in the biz, so
Yeah, it's actually trading at 86 cents. So it's an actual company. Yeah.
Hey guys, what about
Well,
Wallbridge? Anybody know what's going on with Wallbridge now? They have right down to like 14 cents. They have like 5 cents worth of cash on their balance sheet.
okay, so Wallbridge is another company that I've watched for years, and it got cheap enough, I bought it. So yeah, I think Wallbridge has got oversold here. I think I like the property. I think it's going to be a big mine. I think it's growing in size. As a spec bet, I think it makes sense here. So I mean that's how I invest. I mean I'm basically a speculator. If these stocks get oversold, if they get so cheap that they just start to make sense, I'm jumping in. So you look at their chart, and it's pretty crazy how cheap it's gotten. It's trading at 12 cents US. 12 cents. So the market cap's down to $100 million. So 100 million is kind of where I start to get interested. Any stock that's 50 to 150 million that has a really big mine, I start looking at multiples, right? So I think that the Finland project it's on 200,000 acres, 50-mile trend. They have 6 discovery areas. I think it's at least 4 to 5 million. So then they bought Balmoral. I think you're basically getting Balmoral for free, right? I mean, it's $100 million market cap. That's Wallbridge. Wallbridge was already a big thing, and then they bought Balmoral. I don't know if you guys remember Balmoral, but Balmoral was a pretty big company. So you're getting Balmoral for free here.
Yeah, and now they got like 65 million for their like nickel assets, So they got like a lot of money for that place.
Yeah. The nickel access you're right. I think that the nickel projects are worth 50 million bucks. They should sell them for cash, and then put all that cash on their balance sheet and then use it. I have them with 40 million cash, so they should basically sell that nickel project. I think the nickel project's probably worth 50 million, maybe not. Nickel went down a little bit, but yeah, they're super cheap right now. I'm glad you brought it up. People can take a look at it. But yeah, I jumped in. It's like this got ridiculously cheap here. I think it's at least 4 or 5 million project, and maybe it could be as much as 8
I think
potentially.
I think somebody's gonna come for a takeover, and that the share price is kind of like being manipulated these days. I think maybe Agnico or someone else in
I
that
don't.
area.
I'll be really disappointed if they sell. They don't have to sell. They have plenty of insiders. They don't have to basically step on their shareholders here. Eric Sprott's there. I don't think Eric Sprott's going to raise his hand and say, "Yeah, let's give it away." I think they sit on it until $1 billion. So if they sit on it to $1 billion, that's a 9-bagger. That's my feel. But well, it's probably a 5-bagger because they're gonna dilute. And they're probably going to de-risk, but I don't think they sell before $1 billion.
But Agnico has like a mine next to it, So I think all of
They're not.
their
Yeah,
resources gonna go there. For
but
the
they're not.
cash and
They're
everything.
not for sale, right? But they're not for sale. I just don't think they're for sale. I think they're going to drill for a couple more years, and then they're going to start de-risking. And then if they drill for a couple more years and they don't sell, then the price of gold goes up, and then what's 5 million ounces worth in in Quebec?
I think that the current CEO, I don't think he's capable enough to make it into a mine. The guy from Kirkland. What was his name again? The former CEO. The pretty
Was
famous guy.
was Tony McCooch?
Yeah, yeah.
Yeah,
He's on board now with Wallbridge. I think he's gonna.
yeah, yeah.
He
Yeah.
wouldn't give it away to Agnico ever.
No, he won't.
Yeah, it's
I
gonna
don't
be
think he
interesting.
will. No, I think it depends on how big it gets, but I think it's a minimum 4 to 5, and it's probably a lot bigger than that. So we'll have to wait and see how big it gets.
Yeah, and I
That'll
want to tell you
decide.
something else. They have like 20 million in tax credit too. Like there's a
Whoa,
lot of tax
whoa,
credit too.
whoa! I didn't know that. That's a big chunk of money.
Yeah, so I mean they're pretty much like priced for nothing right now.
One thing for people to be aware of, they're probably going to do a reverse. They have 900 million ounces, 900 million shares outstanding, trading at 11 cents. So they're probably going to do a 10-to-1 reverse here pretty soon. That's something to keep in mind.
Yeah, I think nearby like 5 or 6% is like shorted. Like mostly it's by Goldman Sachs, I think, and Morgan Stanley.
That makes sense.
Yeah. If you look into all the level 2 data, you will see like who is putting all these like shares for sale.
Yeah, it's crazy.
I know something is going on with the company.
Yeah.
But now insiders have started buying up, around like 14, 15 Canadian cents. I have seen a lot of like people buying up.
Yeah. Yeah, it's a $1 billion property all day long.
Mr. Durrett, could you give any insights into Ascot? I mean, they were once a promising project here that it's kind of collapsed.
Yeah, I like it a lot. I like the project a lot. I like the location. I think it just got completely beat up in this sell-off round. They're not the only one. A lot of these companies have been beat up here, and it's like once they started down, they just couldn't turn around. They basically started a downward spiral, and it didn't really matter the company. They all basically crashed and burned. Yeah, Ascot, I mean, it's down to 110 million. It wasn't, 317 in February. So I mean, this thing is, but what's 100, their project, the thing about Ascot, the reason why it's kind of crashed here is that they lost their financing. And once they lost their financing, investors lost confidence in the management team. And once they lost confidence in the management team, it's just been a bloodbath, and nobody knows how they're going to fund this gap. They're probably going to dilute it into the ground because they won't be able to borrow the money. So everybody's worried about the dilution. But yeah, the risk went up. I'm not sure how they're going to finance this CapEx. They're short at least 25 million, which isn't that much.
Right. Somebody came in and bought last Friday. They had about the third most volume in the company's history that I see on the over the counter. 25 cents right there at those 2020 COVID lows. So it's starting to look attractive in price, and
So we're looking at production in early 2024. So we got 18 months, something like that, before they got to raise some money to get there, but no production for quite a while. So we got the rest of this year and then all in next year. And so it's probably gonna start looking much better once we get to January. So we're about 5-6 months out. And then if they can raise some money, we need gold to go up though. We need gold to get back up to 1800. But they're not that far off, right? I mean, January 2024 is not that far away. So this project definitely isn't dead. It's not dead at all. So I have the cash cost at around 750. So, with inflation, maybe 800. That makes their break even around 1300. 1300 is definitely an economic project. They're not, this thing's going to hit the ground, and it's not a huge capex, not a lot of debt. It actually makes perfect sense. It's bizarre that their financer walked away. It's bizarre. It's like this isn't a problematic project. So, I don't know what happened. It's like what?
It's my understanding that it was with Sprott. They had a disagreement on how to satisfy the conditions, the drawdown.
Yeah. It's crazy. It's almost as if Sprott was paranoid that they weren't going to be able to hit their projections. It's like your grade's going to come in low, you're going to have cost overruns. We don't trust your 1300 break even. We think it's going to be 1600. Yeah, Sprott had a huge margin of error there, and they still didn't want it. So yeah, I don't know what to think. I don't like the fact that we have a lot of unknowns still, but I do own it. If I didn't own it, would I be buying it here at 110? Maybe. I might be buying it here if I didn't own it, but I'm not adding more shares.
So let's say, kind of a zoom out, you do hit the 5-bagger, 10-bagger, you won, you hit it good, you timed it right. What do you do with the money afterwards? Do you keep it into something safer, or do you just use that as more chips to gamble with, as far as personally for your own strategy?
My exit plan is to sell to the top, and my exit plan, my feeling is that this is a once in a lifetime opportunity, that you basically get in now and you ride it to the top. So how do you ride it to the top? What I've done, and I wrote about this in my book, my exit plan is that I'm going to sell the winners first. So the 5 and the 10 baggers, those are the ones, but I'm not going to sell 100% unless I feel that it's not going to keep running. Basically, I'm no longer a believer in the project. It could be a location thing. Let's say I have a stock in Africa and it's a 10 bagger, and I don't think, I think it's probably better to just get it off the table. But if I feel like the company is going to keep growing, then I'm only going to sell 75 to 80%. And then that cash, I'm going to have to decide what to do with. But the other 20 to 25%, I'm going to put a trailing stop on it, a 20% trailing stop, and then I'm going to let it basically stop out. And then if the price of gold and silver keeps going higher, then that 25% in theory could make more money than the first 80%, depending on how high gold and silver goes. So my cash balance is going to be growing. So what am I going to do with that cash balance? I'm going to have to decide. And one of the things I'm going to do is I'm going to put it into foreign currencies. I'm probably going to put it into emerging market ETFs, depending on the emerging markets. For instance, Vietnam, I like Vietnam. I think it might do well over time. Indonesia, Thailand, those three countries, I might, do some ETFs there. I might, there might be some technology companies that I like off to the side. There might be some natural resource like water that I like. One thing I'm interested in is like, instead of a REIT where you invest in real estate, there might be something like farming producers that I'm confident in, like San Joaquin Valley. There might be some companies where you could buy like walnuts and pistachio and almonds. They might own like 50,000 acres and trees, and you could basically get an annual dividend. Something like that would make sense to me. So I'll be looking at basically investment alternatives, but I'm not going to reinvest in miners.
All right, we might start wrapping it up here shortly. I don't know if anyone else has questions they want to ask here. He's been on a while. We had a little interruption, but it's just been amazing having you. Thank you so much for joining us. It's been so great to have you here. Liberty, did you have any other questions or things you wanted to kind of talk about?
Could I please ask? Go ahead.
Go ahead, buddy. No, you go ahead.
May I please ask Don if he does any covered calls? Buying the stock or buying the futures, selling a call for income?
No, I actually played with options for hedging a while ago. I mean, it's been at least 5 years. I was basically hedging using FAS options. FAS are 2x financial bears. So basically betting if the stock market goes down, then basically the options go up. So I tried to do that, and I ended up breaking even, but I found that my personality, it just didn't fit. I didn't like timing the market like that, because when you're betting on an option, you're really betting on a time frame. You're timing the market, for instance. And I found that my personality, I don't mind going underwater as long as I feel that I'm doing this for the long term. So my personality was basically buy and hold, and then kind of replace stocks that go under. Like, Aurcana is under, and then Rio 2 looks like they're under. Waluna looks like they're under, so I'm buying stocks to replace them. So if stock goes under, I just replace them. So I'm buying Regis and Dundee and a few others I have on my list. So that's kind of how I do it instead of hedging.
I understand.
But I want to say this, though. I really respect people that are good at trading. I think that trading is the best way to make a lot of money. I think it's just a smart way to do it. You just have to have the right personality. It's not easy to trade, but I like the whole idea of letting your winners run and then basically selling your losers. I like that thought, that mentality. But the problem is it's really difficult to do that in the miners, because the miners, it's more about catching your runs, and it's really hard. Runs are rare, right? So if you're letting your winners run and you're chopping your losers off, you're going to be selling left and right. It's not an easy thing to do in miners, but that's the best. That's the smartest way to invest.
Also, before you go, we do want to hear about your book. So tell us a little bit about that, and what kind of motivated you to write that, the one about the politics.
Oh yeah. So let's go to the top of the hour. We have 15 more minutes. So let's talk a little. We'll talk a little bit about my current political book. So I've written about 15 books, and I write in a lot of different genres. Politics is just one of them. And so because I'm having interested in politics. This is my second political book, actually fourth. I've written 4 political books. Forgot about that. My cousin, he's a conservative, kind of a Trumper kind of guy, and I'm agnostic when it comes to politics, really, because I'm a liberal utopian, which doesn't exist. I've never even found anybody that has the same political mindset as me. I just don't fit in. So he wouldn't talk to me about this political Cold War that's happening today. I would basically tell him, there's a political Cold War where the left is basically wants to create a new America, and then the right wants to hang on to the old America, and neither is going to work. And he even want to discuss it, right? So I said, fine, because he'll read my book. So I decided I'm going to write a book on it. So because he'll read my book. So the whole purpose of the book was to explain how both parties are leading us down basically no solutions. Neither party has the solutions because neither party will admit its weaknesses. And if you don't admit your weaknesses, you're never going to find a solution. So that's the whole purpose of the book, is to expose both parties.
I'm going to have to check that out.
It's a good book.
We can guess who the forward's written to.
So maybe stay on politics and amalgamate for a moment longer in terms of the markets and whatnot. You know, we always get wrapped up with the Fed. It's the easy elephant in the room to look at. And because it's been in the center of attention for so long, I feel like we've forgotten about the politicians. What do you expect in the next phase of this crisis when it comes to fiscal policy? Do you think that the Fed will hamstring the politicians at all when it comes to spending, or you think it's about to be out of control? You know, Peter Schiff, QE infinity, just print the books away.
Yeah. Peter Schiff was spot on when he called QE into infinity. He's absolutely right. He's wrong about Bitcoin, but he's right about QE to an infinity. So what's happened is, I mean, you can go back to 1989. That's when it all started. So 1989, Japan, basically, they had a real estate and a stock market crash simultaneously, and basically an economic crash. They all hit them all at once in 1989. So in 1990, Japan didn't know what to do, right? They basically, what do we do? So they decided to bail out all of their zombie corporations who were all bankrupt, and they basically bought their shares and bought their debt and let them basically stay in business even though they were zombies. And then they started buying, basically the stock market ETF, and then they lowered their interest rates to zero. And then they started buying all of their bonds. They basically started this MNT thing. They basically started, which had never been tried before, basically. This whole idea of bailing out both your government and your businesses simultaneously, and letting your central bank kind of manage the economy, destroying the free market. And by doing that, their growth stopped. They destroyed the free market and the growth stopped. I mean, they've had zero growth for 30 years. And now the US, then we got to 2000 and 2001, and then the Fed said, we could do the same thing that Japan did. They didn't get inflation, but what they neglected to see was that Japan had self-financed their debt, whereas the U.S., they funded their debt externally, which is not the same thing. And so now we're getting inflation. And Japan still doesn't have high inflation like we do today. Their inflation is much, much lower, and so the Fed has, it's the whole slippery slope thing. So then we stopped once in 2007 when Hank Paulson basically said, look, we need to expand our balance sheet here, the Fed's balance sheet and our own balance sheet. And so at that point forward, our debt, nobody's talked about the debt ceiling with any seriousness. Nobody's talked about the size of the debt. If our annual debt is 1 trillion or more, or 2 trillion or more, nobody blinks. And so we know that nobody in Washington cares about the debt anymore. So you're going to see an expansion of the Fed's balance sheet. You're going to see expansion of the federal government. We're 23.5 right now on debt that's actually paid interest on. That's going to keep just growing. It's not going to shrink. So the QE to an infinity is what we're going to see the rest of this decade. I don't see any way that doesn't happen. And so we're going to see stagflation. Stagflation's coming. It's going to be nasty. Growth is going to be, I think just flat, just like Japan, the rest of this decade. Japan had their lost decade in the 90s, and I think we're going to have our lost decade here. But I think it's going to be worse because Japan was able to maintain their culture. They were able to maintain their way of life. Whereas America, our lost decade is actually going to be, we're going to lose our way of life. I think it's going to be nastier here than it was in Japan.
Can I help with what? Go ahead, please.
Well, I was going to follow up to that. You know, you hear Jim Rickards talk about the idea that you could peg the dollar to $5,000 gold. Zoltan Polzar has come out and he's talked about backing fiat currencies with a basket of commodities. Maybe it's mixed up with gold and oil and other things like this. Do you see a Bretton Woods 3 type system coming for us, or is it really unpredictable? We have no idea what we're getting into.
Yeah, I think Zoltan Polzar, I think he's right. I think his analysis of what's happening in Asia, I think, is really being downplayed or ignored because it's a very contrarian way of thinking. He's basically saying that this is a new era, and I agree with him. When I read some of the things that he had written, I agreed with what he had written, and I normally don't agree with a lot of these institutional guys, but I agree with him. I think a basket of currencies is coming. I think that's what the BRICS Plus is all about. I think they're going to come up with a basket of currencies for international trade. I think that's what's going to replace SWIFT. What's going to replace SWIFT is going to be a new basket of currencies, a new international currency. I don't know what the name is going to be, but I think they're going to give it a name fairly soon. So as far as Bretton Woods 3 or whatever, I do think one's coming. But I don't know exactly, but I think it's going to backfire. I think the U.S. and the Fed is going to have to do some type of a Bretton Woods because the dollar is going to get, it's getting too valuable, and they're going to have to figure out a way to devalue the dollar here when it gets to 115. But I think it's going to backfire and it's going to crash instead of devalue.
Right, maybe a Plaza Accords 2.0 kind of situation.
Yeah. Well, look what's happening. Sorry to interrupt, but look what's happening globally. You're having riots all over the place because of the high dollar.
Right. Yes.
So they're going to have to do something. It gets to 115. They're going to have to do something.
Yeah, I understand completely. And this is what I see playing out because, again, as Americans especially, we focus on the Fed and what they're doing with inflation. But this is Triffin's dilemma to the extreme. The world needs these dollars, right? And they're not getting them. They're expensive, and everything's breaking down because of it.
Yeah.
And so it gives some credence, I think, to that conspiracy we had alluded to earlier in the show, because certainly the Fed can't tighten forever, not only on our own terms in terms of interest rates and our own sovereign debt, but the global economy is going to collapse if they continue to tighten. I mean, at some point they have to turn on the printers. It just stands to reason to me.
Yeah, they have to. There's no doubt about it. They have to bail out. You remember 2007-8? I mean, that was a huge liquidity crisis, right? They were bailing out banks in Europe, and they were definitely bailing out banks in the U.S., but they were bailing out insurance companies. So the bailouts are coming. The mass layoffs are coming. The liquidity injections are coming. The helicopter money's coming. I wrote today that, somebody, a big guy on Wall Street, Hartnett, was talking about, there's a panic coming. And I wrote, absolutely, the panic's coming. There's no doubt in my mind. It's just a matter of when. So, yeah, I mean, we're kind of early innings here for the economic crisis that's upon us.
Right. And Jim, I promise I'll let you go next, buddy. I'll let you have the last word with them. I want to follow up with you one more time. You had mentioned the bailouts are coming. We expect this stuff. I mean, we've lived through it long enough to know that it's coming. And I wonder if after COVID and all the stimmies if the psychology of the average American has changed and they're willing to take on more risk because now they believe they're going to get bailed out. The same way all the institutions have been bailed out, the way the banks have been bailed out, and it's changed their spending behavior. And I wonder if this is impacting some of the data we're seeing and the lack of savings in the credit card. Maybe it's not all because they have to spend more. Maybe it's because they think it won't matter if they max it out because help is coming anyway. They're going to get bailed out. They're expecting that stimulus now.
Here's where it's going to all break, and this is, to me, is very obvious. And this is where Wall Street hasn't figured it out yet, and this is where Wall Street will panic. Okay, so the middle class is basically becoming bankrupt because of inflation. And the lower class is already bankrupt. The lower class doesn't have any savings. The lower classes, they're pretty much already bankrupt. But the middle class now is becoming bankrupt. So the consumer, which is 70% of the economy, is right now becoming bankrupt as we speak in the US. And so that's where the recession is going to come in. And then you're going to start to see the layoffs, which are going to hurt the economy even more. So that's coming. And so what's happening here is this is something that's been in the making since the 1980s. Actually, you can go all the way back to the early 70s, where the middle class has been getting shrinking down, where the middle class no longer has savings. The middle class no longer has wealth. And so the business cycle can no longer restart everything. You know, where basically you lower taxes and the economy comes back, or you do a little bit of stimulus and the economy comes back. This time, it's not coming back because the middle class is bankrupt. And so you have these rents that have gone up. So what's going to happen now is you're going to start to see people who are going to basically start defaulting on their loans, their rents, their mortgages, their cars, their credit cards. All this stuff is going to start happening. But we're not going to crash. But what's going to happen is it's just going to basically, everything's just going to grind to a halt. It's going to grind to a halt, and there's going to be no way to restart it because I don't care how much stimulus you give them. It's not going to last, right? It's like,
right.
It's like they're going to try to prime the pump, but that's going to create more inflation, more stagflation, but it's not going to work. And I've been saying this, is like, you're not going to be able, there's been too much damage to the economy by COVID. And there's been too much damage to the economy through deindustrialization. And there's been too much damage to the middle class. It's like all this stuff is basically going to come home to roost right now, right where we're there. And Wall Street seems to think that this damage hasn't happened and that all we need is earnings to come up and Wall Street is going to start, going again. But what they don't realize is that Wall Street for the last 2 years has been fake. All that growth in those assets has been done through basically stimulus and printing money. It's not a real economy. That's not a real stock market. And what's been happening under the scenes is that the average consumer is bankrupt. The average middle class family is bankrupt. And now what do we do? And now rents aren't going down. Food prices aren't going down. People are tapped out. This is kind of a 1989 type thing. We're turning Japanese here. We're like, we're dead. We're stuck. We're trapped. We can't grow. We're like, this is it. We're dead. We're done. But they will stimulate. There are going to be a lot of stimulus to prevent a crash. So I don't see us crashing, but I don't see us growing either.
Jim, go ahead, buddy.
Thank you very much. I'd like to just add to what Don is saying, maybe add some numbers so the listeners can kind of get a grasp of what's going on. When Mr. Obama came into office, the debt was $9 trillion, the U.S. debt. And that's just a summary of what they've got online as a consistent measurement. That debt now, since 2008, 2009, has gone to over $30 trillion now. Okay, that's one. The other thing is that the Federal Reserve, they're likely, they're going to have a 2-day meeting this week, Tuesday and Wednesday. Wednesday at 2 o'clock, we're going to get a decision if they're going to raise the rate that they can affect. It's the federal funds rate. It's the rate that they charge Federal Reserve member banks to borrow. Okay, that's one side of the equation. The other side of the equation, I'm a futures broker, so I watch Treasury bonds, Treasury notes, that kind of thing. The other side of the equation is the marketplace. Well, the marketplace, the 10-year note rate went up to about 3.25, 3.30, 3.35 recently when the Fed started raising their rates, the federal funds rate. But this last week, this last Thursday or Friday, that rate got down to like 2.86. So the marketplace is already saying, I think to what Don is kind of hinting that, look, folks, we got a problem here. Rates going up. Everybody that owes money, that's a big deal. But that's the rate that the government wants to pay you for lending them money for 10 years or 5 years or 7 years or 30 years. And the 30-year rate is like 3.09, or it's probably 3% now when the 10-year came down on Friday. So they're asking you to lend them money for 30 years at 3% a year, or for 30 years, or 2.75 for 10 years. Well, that's fine, except that the local customer for those might be hedge funds, might be bond funds, institutions, but institutions are also pension funds. And pension funds need to earn a return that I think that they need, I believe, they need north of 6% to make their nut, to pay their pensioners, what their monthly checks are. They need to make 6% or north of 6%, maybe north of 7%. And the marketplace isn't there unless they're using some inflation bonds or some, treasury bonds or junk bonds, that kind of thing. So it's, I guess, reinforcing what Don is saying. It's kind of a mess right now that, like Don says, the consumer is the economy in the United States. And the consumer, if they didn't have credit cards, to help pay their gas bill, everybody pays at the pump with their credit card. And then when the bill comes every month, maybe they don't pay it all off. Well, that's borrowing money. And if the consumer is getting deeper into debt, at the same time, the Federal Reserve is going to charge banks more if the federal funds rate gets up north of 4, north of 5, north of 6. Credit card interest rates are probably going to be 20, 18, 19, 20 or higher. And it's just really hurting the consumer at the same time that gasoline is, well, let's call it 4.25 a gallon. It was, higher than that, but 4.25 a gallon. So it's not a real healthy outlook right now for the 70% of the economy that the consumer is. The consumer fills their tank. They can't fill their tank and buy groceries at the same time. They've got to kind of spread that out. Thank you very much.
Sure. One thing I would add, you guys still there?
Yes, sir.
All right. So one thing I would add is that the last 2 years, since COVID began, if you go back to March of 2020 and you look at the increase in cost for the middle class, and again, we already know the lower class is pretty much, they're hurting. Their budgets are broken already. But if you look at the middle class, you go back to March of 2020, rents are up 30%. Gasoline prices are up 30%. This winter, natural gas prices are going to be up 30%. Food prices are going to be up 30%. And I say the inflation's 10%. But the actual stuff that you need, these are things you have to pay, right? You have to pay your heating bill. You have to pay your rent. You got to pay your gasoline. You have to pay food. You don't have a choice. All of those are up 20 to 30% since 2020. Well, nobody's gotten a 20% raise. So the average family was already pretty much living paycheck to paycheck. So what's happening is the net wealth of families is shrinking, and they're no longer able to afford to travel. They're no longer afford to go out to dinner. They're no longer afford to go to movies. All this stuff is going to start to impact the economy, where the economy starts slowing because all of the extra money. I was reading where this one company, their sales had dropped 50% since March of this year. So just April, May, June, just in the last 3 months, their sales had dropped 50%, and they laid people off. That's how fast this recession's kicking into gear. And I think their experience is going to be happening to a lot of companies. It's happening pretty quickly.
Well, Don, you have been just about as good of a guest as you could ask for. Extremely generous with your time and thoughtful with your answers. Very insightful in every way. Couldn't be more thankful to have you on. It's been a real pleasure and a real honor. And, you are absolutely welcome anytime you want. But if you don't stop in, I'll have to bug you and poke you here maybe in a few months or something and get an update on what's going on. But again, it's been a real pleasure. If you kind of tell everybody, go ahead.
Yeah. So the time was actually really good for me. So 5 p.m. Pacific on a Saturday, it's actually a good time for me. So with the exact same time in a couple of months will be good.
Well, we look forward to it already.
Yeah, we'll see. We'll see if I was right about the recession, in getting here a lot faster. So yeah, let's go for a couple months. So into September. End of September would be, I think, ideal.
Yeah.
I think by
that'll give us another opportunity for the Fed too. Yeah.
Yeah. End of September, we'll have an idea of if I'm right or wrong about the economy basically slowing and how that's going to impact everything. Okay, sounds good.
Well, thank you so much for coming in. It's been a real pleasure again.
Hey, I want kudos to you guys. I thought you guys did extremely well. I mean, the spaces, the questions, the whole thing. I thought it was really well done. I like doing business with you guys.
All right. Well, that hits home. We appreciate that. Thank you.
All right. Thanks a lot, guys.
Thanks again, and take
Yes,
care.
sir.